Here we go. All right, welcome. Welcome to Oregon Cash Flow Pro, everybody. My name is James Barber, here to help you maximize your cash flow. See, we got it. Oops, making a mess down here. All right, JT, glad to have you with us today. Yeah, I started doing some live streams in the mornings, following along Tesla with the split, and we've gained a whole bunch of new followers, so hopefully some of you guys have joined us tonight. How am I doing with Tesla? I'm doing pretty good. Doing pretty good. You'll have to join one of my streams if you get a chance. They're long enough. You got all day to join. Basically, I think after the ups and downs, at the high point after the split, I was up 6,000, 6,500, something like that. And that was just with trading Tesla stock for just about a month. And all of those gains came from that big run up, just prior to the split and after the split. So I'm just learning it, but Tesla dropped by over or almost 100, well over 100 if you count the low point today, from our high point at which I was up 60 I was up 6 grand. So today at the end of the day we were down almost 100 from there, and I'm still 3,000 up, 3,500 up. So I've been trading, doing some day trades, and I basically secured half of those winnings that I got when we were on our way up. So yeah, holding Tesla, definitely advise, but it's been fun. So anyways, check that out. I'm going to be doing some live streams in the morning because my mornings are typically open. I'm usually sleeping in late. It's a reason for me to get up early and get going. And I've been really enjoying all the people that have been engaging in those. Yeah, I definitely expect it to take off here soon also when we get S&P 500. But we're not here to talk about stocks necessarily unless you guys ask questions about it. This is for you guys. If you guys got any questions about financials, insurance, how to move your money, this is the place to do it. I've got a couple of really good voicemail messages again from Poker. Poker, you are the man. I really appreciate you leaving some awesome voicemail messages. We're gonna drop some knowledge bombs today, and hopefully help some of you guys out. So for anybody that's in the stream, just know I do give away some of our merchandise during these live events, and that happens later on. To participate is really easy. All you have to do is comment in the chat with a number, but not until we're ready to do a drawing. So if we get a lot of people in here, I might do a couple of drawings. Otherwise, we'll just do one closer to the end, and we try and go for about an hour. So what we do for the drawings is you just pick a number between 1 and 10. Everybody makes their guess. I do a random number generator that you guys can see, and we go from there. If a number of different people pick the same number, we'll do a random number generator to narrow it down among those folks. So that's how it works. And let's go. You guys got any questions for me tonight? And if you don't, it's okay. You can think about it. We can jump right into the voicemail question and kick things off. Let me see what you guys have to say here. You heard it dropped from their announcement. Yes, it did. Tesla definitely dropped quite a bit. It's been a fun roller coaster ride. Some people can't handle that very well, but they've found that my live stream actually helps keep them a little bit calmed down. So it's been pretty cool. Do I have advice on raising private capital? Ooh, I do not. I do not. Build your own bank. There's a lot of companies out there that can do that. So there's a number of different sources. I guess it depends on what you need the capital for, and it kind of that'll once you start there, you'll figure out how to narrow it down. But not my area of expertise, unfortunately. Although there's a lot of people in the infinite banking industry who are using that to finance and offer private capital. So we shall see. In fact, I talked to a young lady today who is getting her infinite bank set up. She started a couple of years ago, but she's planning on doing just that. She's planning on providing that type of funding. Hard money lending, that's what we call it. So you might look up hard money lenders and see what's out there. Also depends on how much you're looking to spend. Some hard money lenders charge quite a bit. You may not want to go through some of them. Do you send option alerts on what? Option alerts on what? No. I am just a new trader dipping my toes in the water. I'm not an options expert at all. I don't offer anything like that. So definitely not the place. Top Gun. It's not insurance related, but it ties into IBC. Yes, it absolutely does. So there are people that are using their infinite banking policies to do private lending. But I don't have any advice per se unless you have a specific capital raising need, and then I can look into it. But there are quite a few people who have infinite banks built up that are doing that are probably watching our feed. Maybe not this one, but overall watching the channel. So we can always put a shout out if somebody's trying to raise some capital. At some point, I'll let people know if there's something available if they want to help out with. I'm always interested too. So I may or may not have something available, but if you want to reach out to me, you can do that. Let's see. Wazy, keep up all the great work. Hope you get a chance to post a reaction video to Ron Barron on his thoughts on Tesla. Oh, reaction videos. I haven't even thought about those. I watched one of his videos the other day that was pretty good. So I'll have to look into that more. Micro, how should I play Tesla? Is it a good buy right now? It actually dropped in the after hours trading. It went up quite a bit too. It went up to 470 at first, and then it dropped down. I think it's back down around 430 now. Let me take a look. 437 in the aftermarket trading right now. We had a couple of spikes, once up to 473 and once up to 459. But other than that, it's basically been hanging around where it finished, other than the slight drop that it's at now at 441, 437, right around that area. So up to you. It depends on what your long-term strategies are. I tend to not try to give specific advice on stocks, but I'll tell you what I would do in this situation. My thinking right now is I kind of like where it's at. If I had a number of shares to buy, I would probably get in. I'm sitting on some room where I can pick up some shares, but I'm holding it because I'm happy with where I'm at on the number of shares that I have, and I want to have some cash available if it drops from where it's at. Today we hit 400 as a low, and I didn't have any gunpowder available, so I'm hoping to fix that. If I see that tomorrow, I'll have something available. And if it goes up, I can still jump back in. So that's my plan. Thoughts on earnings for DOCU? I do not know DOCU. Sorry. Andy, buy today, hold 10 years, thank me later. You guys are going to get used to seeing that, and it is good advice. So if I had bought and held rather than trying to trade through that rise with Tesla, I missed out on $8,000 worth of growth because I just missed out. I sold, and then it started to shoot up pretty quickly, and I thought it's going to come back down, so I'll just wait. I'll just wait till tomorrow. It'll come back down. It didn't come back down. I missed out on $8,000 worth of growth that I could have locked in. So today, if somebody had bought and held that, they would be $8,000 richer than me. Other than that, doing mostly the same stuff. So, yeah, reaction videos can be fun. I tend to spend my time doing things that provide value to you guys, and most of that is if I'm going to do a video other than a live stream, I try and make it educational and do a deep dive into something, and it's typically something that has to do with maximizing your cash flow, insurance, or moving your money around, something along those lines. So reaction videos on Tesla, probably not going to come anytime soon. There's a lot of people who know way more than me when it comes to Tesla. I am just getting into it. So you're welcome, Micro. All right, I'm going to start our first question I think you guys will like it. I mean, I get two really good questions today, both from Poker. I do not pay him to leave all of these messages. He, in fact, started his infinite bank with somebody else. Like he's already in this process with somebody else. He just found the channel and loves interacting with us. So we really appreciate. Everybody should thank him for his awesome questions that are pulling out a ton of good information from me. Here we go. Uh-oh. It's not playing. Where's it at? I think I silenced it. Let me start that again. Hang on just a second. We're going to start this again. Let's see, why is it not working all of a sudden? What is going on? I have not had this problem. For some reason, it is not starting, and I don't know why. It's always started in the past. Let me try the second one. Okay, hang on a second. Let me check my settings. Why are you not working? Viewer questions. Show that it's on. Okay, let me go back and check my settings for these. Just a second. All right, let's see if this kicks on. We're having a live stream fail right now, and I'm not sure what's going on. This has always played before. Alright, let's see what you guys are talking about. Might be a question. Just saw a video. There was a flash crash on the S&P 500. That was something. Oh, flash crash. When did that happen? Kick the computer. Yeah. This is really weird. I don't know why it's not doing it. Let me try pulling it in a different question area and see if that works. I might just have to re-download this or put it in a different spot. So we definitely have some good questions to get to. Alright, what is going on? These questions are not playing. Sorry guys, we're having a major malfunction and I am not sure. Hey, my Streamlabs is working. Yeah, well, it's figured out how to work in the chat, but it stopped working here in our viewer question, which is unfortunate. Oh, 2008, 2010, somewhere in there. Yeah, there's that's happened a few times, I think, when you get the computers that are set to automatically trigger, and those flash crashes, man, they're not good. It's like a tidal wave. I think that's when they started instituting shutting things down when it hits a certain point, so it kind of is a reaction to those flash crashes. Let's see. It's not there. Man, something is going on here. I don't know what's going on, guys. I broke it. Alright, hang on. I'm going to open this up in a different... source. Let's see. Let's go audio. What? Olivia? If you just open the door, you can grab the ice out. Don't have to do that. Okay. No, not that one. Let's see. I need... Bear with me, guys. We're working on this. Not sure what happened to that source, but... Which is this one? MP3. Okay, let me see. I'm going to try and add a new source in here. And... We'll see if this kickstarts it. So give me just a minute. Okay, let me turn. Okay, we got. No, that one's not making a sound yet, but I need to change the output. This is some riveting live stream, I'm sure, but bear with me. All right. None of these are playing. Thanks a lot, Top Gun. Oh, you did the super chat. You were right. It is. So when you do super chat, $5 on super chat pays out $3 through YouTube at the end of the month or whenever they end up sending out their checks. But through Streamlabs, I get like $4.50 of it. It's way more. So pretty interesting. Pretty interesting how that split works. Much appreciated, though. Obviously, not really that big of a deal which one you use. It's all right. Let's see if I can do this a different way. I'm going to pull up my browser. We're gonna switch screens to my browser. So give me just a second while I set this up. I'm just gonna go straight from the source and see if this will work. Yeah, PC caught the Rona. No kidding. How to donate to Streamlabs is, it should automatically post. I don't know why it's not. But this is the link. Give me just a second. There is the link for Streamlabs. All right, let me find the source and pull it up. In fact, let's do it over here. Okay, let me change the source. Get to my, there we go. All right, we're gonna move to this page and see if I can do this. See if we can get some sound from this page. Let me know if you guys hear this. Low. Okay. All right, we're going to start it again. See if I can make this a little bit louder. Still can't hear it. Okay. No good. Okay. Okay. That's as loud as I can get it using this. Let me see if there's something else I can do. Yeah, I'm not sure why. hang on a second. Let me pause that again. Let me try this one more time. Back here.
Hi, James. It's Leonard, aka the Poker Paparazzi. Just want to give you props for all your morning streams of late regarding the stock market and Tesla. I think it's a great addition to the content that you already put out, and I think your audience is getting a lot out of it. Today, I actually had a question. Since it's Wealth Care Wednesdays, a combination of wealth and health. I think with the whole COVID and financial instability, shall we say, of life in general, I wanted to ask more from a maybe a mental health perspective of your approach of how to stay motivated when things may seem bleak. Because I think with the mental health portion, it kind of drives motivation and drive, determination, willpower, all those things that ultimately hopefully get you to where you want to be, or the wealth side of things. So just want to, hear what you might have to say about motivation. Thanks.
All right. We figured it out, finally. Okay, so question is about healthcare, taking care of yourself so that you can keep your financial house in order. I hate to say it, but I don't think I'm a good person to answer that. As much as a good question it is, I don't have any experience when it comes to motivational speaking necessarily, or psychology. Don't have any background in that. My guess, well, and let's put it this way. I'm pretty even keel guy. I don't have the highs, and I don't have the high highs and the low lows that often become associated with those emotions. And so it's kind of this even keel that allows me to see Tesla drop 100 points and I'm not freaking out. So meanwhile, other people on our stream were kind of freaking out. So I don't know if I have the experience to answer that question, but it is a very good question. So I'm sorry, I can't give you the answer. For me, it's just, I would say, try to focus on the goal. Try to focus on the goal. If you can try to remember your why, remember why you're doing things, it might be able to help you center. Pause. Don't be reactionary. If you find yourself getting heated, take some breaths. If you find yourself anxious, try and take some deep breaths. Might be helpful for you. I don't get in that situation, so I'm just kind of repeating what other people I've heard said is helpful. Taking some deep breaths is basically helping you pause. Some people take the time to pray, and what I see, I don't do that, but what I see that do is it allows people to kind of offload whatever it is they're anxious about. And so I think that's where the effectiveness can be. It allows them to stop worrying about it, and there's value in that, whether you believe if it somebody's out there hearing it and responding to it or not. I see value in it as allowing you to not worry so much about it because you kind of think it's handled, and things tend to work out one way or the other. Oftentimes, it doesn't matter what you do about it. It's what's going to happen is going to happen. So, Wazy says yoga and stretching. There you go. That's certainly a good way to go about it. Maybe go for a walk, doing some exercise. Anytime you get your blood flowing, it can be helpful. Swim in a pool works great because that gives you a lot of time to just think. As long as you're not going to spend that whole time worrying, if it's a distraction, that can help out. And oftentimes, when we get into those situations where everything is calm and we have time to think, we're able to come up with solutions. We're able to think of things. But I wouldn't want you doing that if you just spend that time worrying and doing things that kind of make the problem worse. but take it from somebody who self-admittedly says, not my area of expertise. So great question. Hopefully that helps out at least a little bit. Now the next question is a lot more in-depth. I mean, I'm probably going to talk quite a bit on it. What are we looking at? 627. Oh, okay, good. Well, hopefully there's some value in that. I hope you weren't asking for you. You seem to be pretty even keel as well. But if it is, hopefully you can find some way to help out. I'm going to play the second question here. It's a really great question. And then once I answer that, we'll do a drawing. Actually, I know it's getting late for JT. Let's do a drawing right now. We'll do a drawing right now. I'm going to pull up. We'll do the random number generator on screen. So I'm going to switch back to that other screen. And we'll do the random number generator on there. That way I don't have to hold my phone up. Might be easier to make sure that we can see the results. So switching back to that screen. Okay, let's do this one. Hang on just a second. Preparing that screen. Give me just a second. We're getting there. Okay, for some reason it is not. Oh, I know why. I need to move that backwards. Hang on just a second. I'm moving it the wrong way. There we go. All right. I'm going to pull this up. Get your numbers in. Numbers 1 through 10, everybody. We'll give you a little bit of time. Pick a number. And remember, the prizes, I guess I didn't mention it earlier. You get to pick your prize. We have a Teespring store, which the link should be in the description of this video. We also have 2 books that are in every video that I put up. One of them is about infinite banking. One of them, that's the Becoming Your Own Banker. One of them is about IULs, Index Universal Life Insurance, and that's the Retirement Miracle. 2 different products that serve 2 different needs. I love both of them for what they can provide. If you haven't read those, I highly suggest it, and that's why I'm willing to give them away. So you can pick between anything in our Teespring store. Top Gun, Bobby loves the hoodie that he got. You can see a picture of that if you go to the Communities tab on our channel. He says it's really comfortable. That is I think it was a $50 value, including shipping. So you got that opportunity. Otherwise, we got books. All right, we see a bunch of numbers out there. I'm going to go just a few more seconds, and then we will do our random number generator. So let me pull it up on the screen. Here we go. So if you're on the stream, get your numbers in. Giving away our first prize. Now, if you win, nice, loves the hoodie. It looks comfortable. You look like you're comfortable in it when you took the picture too. You can't see the picture here. So if you win, here's what you got to do. Email me, james@OregonCashflowPro.com. If you haven't already, if I don't already have your email, I may already have some of your emails, but if I don't and you win, email me. I will email you the links. What you do is you go to the site, pick what you want, order it, and then send me the receipt. When you send me the receipt, hopefully you'll have PayPal. I will reimburse you from PayPal immediately. If you don't have PayPal, let me know. We'll figure out another way to do it. But that's been working really well. And it makes it so that you don't have to send me your address. It'll just get shipped right to you from the manufacturer or the Amazon. So whichever one gets used. All right, here we go. 5. Who's got number 5? Michael. Do we have any other number 5s? New listener, new winner. Michael Fleming. All right, so you understand how to claim your prize. send me an email, james@OregonCashFlowPro.com. The big bag of money. That would be nice. So Michael is our first winner. Send me that email and I'll get you the links you need. Or you can just go right to the links and email me the receipt. But either way, we'll make sure you get reimbursed for that and you'll get the stuff on your way. So congratulations. And yeah, you win twice. Okay, let's go to the next question. Let me switch back. Oops. Don't want to play that one again. I don't know why it's playing that one. Hang on a second. Oops. This is our same question. I'm not sure why it's playing it again. Why is it playing that? This is so funny. So according to what I'm looking at, that's turned off. Okay, I wonder if it's because I'm in studio mode, so it's not changing things immediately. That's the problem. Okay, let me get out of studio mode. Here we go. All right, now I can control it. Here comes question number 2.
Hey James, it's Leonard, the Poker Paparazzi again, and I actually wanted to follow up with regards to the Wealth Care Wednesday topic, which is how you personally leverage your wealth building blocks. For example, if you wanted to invest money in the stock market with companies such as Amazon, Tesla, and so forth, how would you break down the income passing through into, let's say, your infinite banking, your dynamic banking, your life insurance policies? Can you kind of walk us through, I guess, the step-by-step cycle of how that money could make it into the stock market and then back out into your personal dynamic banking type situation? I'd love to hear more about your personal insight about that. Thanks.
All right, we're getting these hiccups figured out. Now, I love the question. You want to know how do I move my money around, right? Now you ask for step by step. I don't really have a step by step. What would you call it? Template, necessarily. But what this boils down to, and I kind of go over this in my last video that I put up called Revisiting Wealth Building Blocks. When we consider personal wealth building blocks, if you don't know what I'm talking about, check out the Wealth Building Blocks videos. What I do is I go through specifically and identify how to take regular expenses that you would normally have and how to turn each regular expense into a personal wealth building block. Something that is currently just a regular expense. You might have car payments, house payments, utility bills. It really could be any expense, taxes, property taxes that you pay. Anything that you pay regularly that you might normally just get paid, put that money aside, or have it sit in your checking account until payday comes around, and then you make that payment. So that's kind of like the typical way that money gets moved for your average person. Okay. What I do and what the wealth building blocks is it says you actually have the ability to take that expense that you normally have, divert those funds into your infinite bank, and we use an infinite bank specifically, which is high cash value, whole life insurance, or you can do it with an index universal life policy, But for the most part, we're talking about whole life policies that are specially designed for high cash value. You can divert an expense into that policy and then bring it back out again to pay the bill. And that does two things for you. It helps you to increase your premiums in that policy. So trying to get up to the most, there's a maximum amount that we can put into those policies every single year, and we want to hit that max every single year. So this helps us get to that point. But I also in those videos go over how you can take each one and what it does when you do that so that it creates wealth for you. You take an expense that you normally have and you create wealth just by moving your money in a different way. Now, I do that as an example, okay? In the last video I put up, Revisiting Wealth Building Blocks, I kind of go over how I do stuff, which is I don't actually, it's sort of like using it as a checking account, but not really, because it's a little bit, it takes a little bit longer to get it. It takes a little bit longer to get it than it would a checking account. Where was I at? But in that video, I basically go over how those individual wealth building blocks are just ideas. The main thing to understand is how we move money matters. And ideally, we want to make every dollar that flows through our hands work for us the most that it can. So when we get money into our hands, when we get income, when we get paid, when we sell something and we just have cash, regardless of what it is, you have three choices with that. You can invest it, you can save it, or you can spend it. And traditionally, you cannot do more than one of those things. If you're saving it, you're not investing it and you're not spending it. If you spend it, that money's gone. You can't do the other two things. And if you're investing it, it's tied up in the investment, which negates the ability to spend it another way unless you get out of that investment. And it doesn't count as savings either because it's generally not considered safe enough to be considered savings, right? Or it may not even be liquid. It may not be liquid to be able to use. Our infinite banks are designed, they're guaranteed when we use a high cash value whole life policy. You're guaranteed growth in those policies by contract. You're guaranteed access to that cash by contract. You can borrow against that policy and you have access to those funds, typically up to 95% of the cash value at any given time. Because of the guaranteed growth, we have what we call break-even period, where you're going to have more money available in that policy than you've paid into it. And we try and get that break-even period to be within about 4 or 5 years. So that's considered your ramp-up period. But it's important that based on the design that we have as much cash available in those first few years also. So we try and design it to get 90 to 95% cash value available in year one. So you have the ability to funnel your cash, what goes to a normal expense, you have the ability to funnel that into that policy to help maximize it. When you borrow against the policy, the insurance company gets the interest. You got to check out my videos. Yes, Top Gun, whole life insurance is the bedrock of sound wealth creation. Top Gun's been practicing this, I believe, or at least he's about to get into it. He's been doing a ton of research on it. But the insurance company gets the interest, but the key is that they also credit your policy. And your policy can be credited with the same amount of what you're borrowing or even more than what you're borrowing. And that's the key to these things. So if you find my videos called Infinite Banking, I have an Infinite Banking Explained. I have an Infinite Banking for business owners. Business owners can really make this thing take off. It's really... I wish I knew about this back when I had my business. I had a business for 13 years. No idea how to maximize the use of the money that came through my hands as a business owner. It would have been a game changer for me. So anyways, what this boils down to is what do you do with your dollars? And for me, so specifically the question was, what's my roadmap? How do I move the money so that I could use it and buy some Tesla with it, because that's what I just did. That's what I did with it, right? What I do, I wake up each day. So I do something called dynamic banking and infinite banking, and I kind of put them together. Hey, Robert, I work with those together, and I urge you to check out my videos if you haven't seen the videos on either of those. Dynamic banking is more about a mindset on how to move your money to maximize your cash flow. Infinite banking is a product. It's something, or it's more of a process, but it's something we do inside of life insurance policy. Dynamic banking we do with lines of credit. You can also do it with a life insurance policy, but it doesn't work as efficiently because it takes more time to put money in and take it out. So ideally, what I urge all my viewers to do, if you want to maximize your cash flow, get a line of credit and do an infinite banking policy. With those two things together, what I personally do, I wake up and I get used to, first thing I do is I get used to any income that comes into my hands, I put it in the line of credit right away. I'm always using the line of credit at least a little bit, whether I'm paying down a debt or whether I'm putting it into a growth product, like my life insurance policies. Okay, so that's the first thing. I always have a small balance at the very least that I can offset every time I get some income. And I take those small balances that I use, those chunks, and I put them to work. I either put them to work paying down debt with dynamic banking. So I might put a chunk of it towards, you can put a chunk towards your mortgage. You can put a chunk towards car payments. You can put a chunk into your life insurance policy. You can put a chunk into the stock market. There's all kinds of things that you can do with it, but we always want to be using some of someone else's money so that when our money comes in, we can offset it, but we've already started that growth process with the chunk. Okay? So it comes to waking up. When I wake up each day, I look at where my money's sitting and I think, is it in the place I need it to be? And if it's not, I move it. So I don't necessarily lay out each individual wealth building block. Okay? I'm not that detailed when it comes to moving that money. I just know when I wake up, I'm going to move my money to where it's going to do the most for me. So the other day, last month, I was like, I'm going to check out this Tesla stock. And I was like, wow, this is moving. I'm a believer in the stock. I haven't really done much in the stock market except for play around a little bit. But I thought, you know what? If I pull some money out of my infinite bank, I'm going to pay, depends on the policy I move it out of, but it's going to cost me basically 4.5% to 6% interest. Can I do better than that in the stock market with those funds? With Tesla specifically, not just with anything, but because at the time I wasn't doing any day trading. I didn't have enough money in there. I could just basically do some trades each day. If I wanted to buy and sell the same stock, I have to wait a day. So my thinking was, yeah, I probably could. Yeah, now I'm hooked. So my thought was, yeah, I probably could. So I did that. I moved the money in. I bought some Tesla stock. And then there was hype about the S&P 500 inclusion. And there was hype about, we didn't even really know about a possible split at this point. I basically bought in because of that S&P 500 inclusion. I was like, oh, it's definitely going to go up when that hits. I want to take advantage of that. So moved some money into my checking account, moved it from there into my stock account. Each day, that's what I do. I just look at my accounts and I think, where's the best use of those funds? I don't worry about if it's a loan out of my policy, if it's a loan out of my home equity line of credit. I'm always moving money to wherever I have the lowest amount of interest that I'm paying. And as long as I'm using it to maximize my return on it, I'm pretty happy. So long answer short, I just move the money to where I think it's going to do me the most good. Now, to get it from my insurance policy to my account to do Tesla, because I don't have a HELOC right now, because I just refinanced my house, I have a bunch more money sitting in my checking account than I normally would. So I don't have a line of credit that I can be using to offset. So my infinite banking policy is where all my income goes, okay? Except I'm sitting on quite a bit of it in there right now. because I got a lot of things that I'm expecting to come out. I'm starting a couple of new policies, so I want to have enough money to pull that out, and I don't want to have to wait for it. It takes a couple of days to get the money out of a policy, and it takes a couple of days to put money back into the policy. I've already hit the MEC limit on all my policies for this year. So anything I start, I've already hit the MEC limit. So I've got loans out of them for when I used them. I can't put any more new money into them this year. Okay. So for me, that's simple. If I had room available, I always try and hit that MEC limit first. For people who don't know, MEC is modified endowment contract. And you do not want to turn your insurance policy into a modified endowment contract because you lose out on all the tax benefits except for the tax-free death benefit. That's still there, but if it becomes a modified endowment contract, when you pull money out, it's just, or when you borrow against it, it's just like you're pulling money out, and they're going to charge you taxes on it as if it's income. So we don't want that to happen. What we do want to do is keep it right up really close to that MEC limit, because that is the most efficient use of our dollars. And as soon as we put money into those policies, it's going to compound for the rest of our life, guaranteed by contract. And we do that with mutual companies. We become an owner of that company. So we end up wanting to do that with really strong companies that have 150 plus years of paying dividends, because we get a guaranteed growth of 4%, but we get the dividends above and beyond that. If the dividends are above 4%, we're going to get whatever the dividend rate is. If the dividends are below 4%, we're going to get that 4% guarantee. So that's why we use those. It is not the most efficient vehicle for getting money in and out of very quickly. So it's like our second tier. It's a great place for storing emergency money, emergency funds. It's a great place for an emergency fund. It's also a great place for capital expenses. We have a lot of real estate investors that get these policies, and that's where they keep their capital funds. You keep it in there, it does a lot for you. One, it helps to grow your death benefit. Two, if something were to happen to you, your properties can get paid off. And three, you get guaranteed growth. You don't have to keep it in a low interest bearing savings account or checking account. We always try and get these dollars to do multiple work for us. So hopefully that answered your question. The main thing I try to get across to folks when you want to know about how to move money is just don't worry about the source of it necessarily. Yeah, when you pull it out of your policy, it's going to be a loan. But remember, we always have a cost of using money. We're either gaining interest or we're paying interest. When we use our infinite bank, we're going to do both. So we're going to pay interest, but we also get credit. So it's always compounding. Okay. Let's see what you guys' questions are. That was a long-winded answer. Hopefully I covered everything. Like I said, the main thing is you want to get used to moving money efficiently. And I think that comes more with mindset than with figuring out the exact dollar of each wealth building block. A lot of people that watch this channel are like engineer types or accountant types that love the detail that I provide in my videos. I put a bunch of spreadsheets up so you can see exactly what those dollars are doing, but you don't want to get stuck in the minutia of trying to figure every little thing out. I put the details up there so that you don't have to worry about those details. You just know if you get the money into your policy, you're going to be better off. That's the bottom line. If you want to get in and keep track of those details yourself, you're more than welcome to. But not everybody likes to do that, or you may already be doing that with plenty of other things in your life. So I'm not trying to add more complexity to how you do this. It's actually pretty simple. As soon as you get used to the concept of money comes into your hands, goes in to offset some interest somewhere. And in this case, the interest that you're going to offset is either in the line of credit or it's in your infinite banking policy. All right, let me see where you guys are at here. You would rather used it for investments, but it meant having your wife on board, so ultimately you wanted to have her support. Gotcha. S&P, yes. It's the best thing ever. JT, I wonder if you can get a HELOC if you don't have a mortgage. It wouldn't be called a HELOC, but you can get a personal line of credit, and you can you can get business line of credit. I know you got a business. Business lines of credit are awesome. So since you have a business, if you wanted to maximize the use of every dollar that flows through your business, get a business line of credit. What that will allow you to do is you can use that line of credit. Let's say you have 30 grand a month that flows through your business. It goes out to pay employees at some point. You set it aside for quarterly taxes. Whatever you do about it, you got plenty of cash that goes through your hands, but for the most part, you don't get much use out of it, other than it does one job for you, and that's to meet those particular expenses. In this case, what you can do is you, as a business owner, can funnel that money into your policy. It fulfills the premium payments for that policy, so you can do a fairly large amount. I have people doing hundreds of thousands of dollars a year into their policy, okay, funneling money from their businesses. And then what you do, and you got to get with your accountant for this, but you loan the money back to your business to pay those expenses. And if you watch my video, I break down exactly how it works and why it works. But what happens is when you loan it back to your business, you're going to make an actual contract. That's why you got to have your accountant with you. You got to make a contract so it's legit, just in case you get audited. But the business ends up deducting the interest cost. So the insurance company, where you pulled your money out of to loan your business, with one of the, let's use Guardian as an example. You get their dividend rate. Well, when you borrow from it, they're going to credit you 6% on the money that you borrow, and they're going to charge you 6%. So when you loan it to your business, you can loan it at 6%, you can loan it at 7%. Really, I mean, you can probably loan it at whatever rate is reasonable according to your accountant and the IRS. Don't want to be unreasonable about it, but your business is going to pay that interest to you, and they're going to deduct that cost. So when they get to deduct that, it reduces the taxes that you're going to pay on that. But what's happening in your policy is you're getting that growth tax-free. You're getting that full growth tax-free. Business is writing it off, reducing your income, but you're still getting the full growth inside the policy. So that's kind of the magic behind it. Check out the Infinite Banking for Business Owners, where I go through the numbers and you can see exactly how it works. All right, let's see. Robert, why is it not recommended to borrow against your policy to open another policy? I don't say that. I don't know who says it's not recommended. I mean, I know there's some people out there that say that. I don't know why they say that. I am not afraid to use leverage. It's just a way to use leverage. If you look at my video where I go over using a home equity line of credit or just a line of credit to almost fully fund a policy, we call that, the video is Infinite Banking and Dynamic Banking. If you look at that video, we're basically using $13,000 of our own money, and over the course of 7 years, we turn that into $87,000 by using someone else's money the whole time, except for that very first year where we put in $13,000. That's a really good return. It's a really good return on your money. You can basically do the same thing opening up another policy. Now, for the most part, you don't want to just open up a bunch of new policies. There should be a reason for it. Oftentimes, you can expand the policy that you already have, as long as your health is still good. But sometimes it makes sense to have different policies. I like to have different policies with different carriers. It's kind of like diversifying, because each carrier is going to earn different dividend rates, and it ensures that regardless of the year, I mean, the insurance companies tend to battle each other for the top dividend rate. Some pay it more one years, other pay it more in other years. So I like having that diversification, but for the most part, we're sticking with the top performers historically. And then each one offers different advantages when it comes to their policies. So let's take Guardian. Guardian is among the top 3 choices that I like. Guardian is the 3rd highest dividend paid. So if you want to see the growth within the policy, Guardian is not the best one to do. But Guardian has the most flexibility. So I write mostly Guardian policies because a lot of the folks need that flexibility in the policy in order to maximize its use. And the actual difference between the dividends is not so much that you're going to reject it just because Guardian this year has a 5.65% interest rate, and their dividend, and Penn Mutual has 6.1, and Mass Mutual has 6.2. The dividend rate doesn't make that big of a difference. It's going to make more of a difference if we can get more money into the policy and you can actually use that money. When it comes to Mass Mutual, we can put in 10x, 10 times the base premium for a lot more years than we can Guardian. But they're not as flexible. They're less flexible. So it's harder to put in large amounts because when it comes to the design of these policies, Mass Mutual and Penn Mutual, really both of those two, they want to know exactly how much we're going to put into the policies each year. I'll tell you right now, none of these insurance underwriters like the infinite banking concept. None of them like to see us put a large portion of our income through these policies. It makes them nervous. They would much rather see a policy that I design that looks like it's going to barely be funded for the next 30 years and could possibly implode because it doesn't get enough funding. They would rather see a policy like that because the low amount of premiums that's designed to pay, they're just more comfortable with you being committed to that. If I take that same exact policy and I bump it up to the maximum amount that it will actually let us fund within that policy, the underwriters suddenly get nervous and they want to reject those applications. So we kind of do a little bit of a dance and we balance out between what we ask from the insurance company and what you're able to do. If you have plenty of income, if you have a lot more income than you're wanting to put in a policy, it's pretty easy to get that into Mass Mutual or Penn Mutual. But if you don't, if you're really trying to do a high percentage of your income, we want to go to Guardian. It's a lot easier to get a policy approved because of the flexibility. Or we may look at an IUL. An IUL has a ton of flexibility with regards to how much you can put in compared to the minimum funding and the maximum funding. And the IUL is also referred to as like the rich man's Roth. It's a great alternative to money that you might otherwise put into the stock market. You're not going to have the same type of returns that you would get out of the stock market, but it's protected. There's a lot of safety that comes along with it. And you do have some potential growth that could really be breakout. With the company that I like for maximizing potential growth, that would be Allianz. And with the specific index options, if you had been in that index option for the last 10 years, you could have earned 14% a year. That's solid, along with the guarantee that you're not actually going to lose money in the marketplace. The only thing is there's insurance costs, and those insurance costs are minimal. So each year, even if there was no growth in the stock market, the only thing that's going to bring your value down would be that cost of insurance. And we minimize those insurance costs in every design that we do. So those can be a good option. A lot of different ways that we can go with this, but it's my job to figure out what your situation is and which one's going to work best for you. Okay, which one is going to help you meet your goals? I'm not going to tell you what your goals are. You're going to tell me what your goals are, and I will say, I'll make some recommendations. This is good for this. This is good for this. And I'm still putting out videos for all of these companies. I don't have different ones, so you may not yet be able to find all that information out for yourself, but I hope that soon you will be able to. My goal is to put out enough videos on this channel that if you want to do all the research yourself, you can do that. You don't actually have to call me to figure this stuff out. You don't have to call another agent to figure this stuff out. You're going to know what a good policy looks like. I've already put a bunch of those videos out so that you can identify what a good policy looks like. So even if you don't want to work with me, let's say you have a relative who's an insurance agent and you want them to sell you the policy, they can watch the video and see what's expected from a design point, because it comes down to design. Almost all of it comes down to making sure that you get the proper design. You really need to have a good company. I mean, that's kind of a given. You got to have the right company. You got to have the right product within the right company, and then that product has to be designed. I can take the best product in the best company, and I can design it to benefit me and not you, and that policy is going to perform like crap. But I could probably design it so that you kind of like it, because a lot of insurance agents do that. Um, Although I'm really bad at that. I tried it the other day. I was trying to match somebody else's really poorly designed policy. I couldn't even do it. I don't know how to design them as bad as that person had got from somebody else. It was pretty funny. So I gave up on trying to match the poorly designed one. But just know that there are some pretty poorly designed policies out there that will not serve you. And some of these agents don't even know it. They don't even know that their policies can be designed better. Talked to an agent the other day. They're doing, what is it that they were trying to sell? It's from one of the major insurance companies, one of the major IMOs, insurance marketing organizations, that sells the most policies that I'm aware of a particular insurance company. They don't work for that company. They don't work for that insurance company, but they sell those products, and they sell more of them than anyone else I know. They did not train this agent on how to design a policy the way that I design these policies. Not even close. They didn't even hint at it. So this agent watched one of my videos and didn't know how to design the policy even after watching how I did it, because he was missing one key part. And that key part basically boils down to how these insurance companies sell their products. And that part was target premium. This is an IUL that I'm talking about, and target premium determines how much the insurance agents, and in turn how much their bosses and those IMO companies, it determines how much they get paid. And so those agents are getting trained to focus on target premium. They want that target premium to be as high as possible. They want to design a policy all around that target premium. So when he looked at my design and he tried to design the policy to match it, it wasn't anywhere close. And he didn't know why. But the reason that the whole design was falling apart was because he was taught to go right to target premium, and that's what you do. That's how you design it. You got to design it for target premium. That's how they score their points. That's how they're rated according to their bosses, is they get points based on target premium. And so everybody in that company, and some of these people sell 20 policies a day, everyone in that company gets rated on target premium. With the policy that he was designing, the target premium was like $4,000 or $5,000 on I think it was like 12 or 15,000 a year premium. Okay. When it comes to IULs, an agent makes anywhere between, well, it depends on the company you're with. Some of them are really bad. Some of them only give you a 30% commission because the rest of that's split between others up above. But a regular agent who's not in a multi-level scheming company, you can make 95 to 115% of that first year's commission. That's what we would get paid on that. And it's based on that target premium. So with his design, he was looking at a $3,000 to $5,000 commission on a $12,000 to $15,000, can't remember the exact numbers, but $12,000 to $15,000 annual premium. I showed him how to get around that. And what happens is when you don't go for target premium, you go for cash value design for the client. First year cash value on his design for that policy was like $0 or close to zero. When we redesigned it, the cash value in that first year, I really wish I remembered what the values were. If it was $15,000, the cash value would have probably been, the accumulated value would be really close to $15,000, probably $14,000 and change, and the cash value would be just a little bit below that, maybe $11,000 or $12,000, because there's surrender charges within the policy. So first year's cash value for you, the client, goes from $0 to $1,000 all the way up to $10,000 or $11,000. And long term, when we play that out to get an income stream in retirement, the difference is probably $4,000 a year on that. When I, as an agent, get paid $4,000 extra that very first year in my commission because of how I designed that policy, it's going to impact your income stream in retirement by $4,000 a year. It reduces it. So that's a really big deal, in my opinion. Now, I'm going to defend them a little bit. Well, I'm going to defend those agents that work for that company a little bit. One, they're not trained properly to design these types of policies. Okay? They're trained to make money for them and the insurance company. And if they try to design it differently, they will likely get fired because they're not going to meet the numbers. Remember, they get scored based on target premium. And so they're competing with other agents in that office to hit target premium numbers. So this company can just shuffle that person out and fill that seat with another body. That's their business model. Even designing these policies as badly as they do, they sell a ton of them because as a product, these products are really good. The IULs are really good. So even if you don't have good cash value in the early years, you may not need that. I imagine the people that are buying these, they don't really need that. They're not being sold that they could use it better or that it can be designed better. And they're probably pretty happy with it because the numbers that end up are still really good. They're still really good numbers in 30 years. Now, that's going to depend on the stock market performing. Part of the big problem with how they design it and who they sell these to is those people often underfund these policies or they get rid of them during the surrender charge period. And with the way these policies are designed, they're out a whole lot of money. If they put $15,000 in that first year and the next year their income dries up, they don't have any ideas on how to make those premium payments. Like I teach you guys how to make premium payments, how to get up to the MEC by diverting expenses. These people don't know that. They come up with a stumbling block. They don't know how to make their premium payment, and now they cancel the policy. They're out $15,000. You start a policy with me, your cash value is $11,000 that first year. If for some reason the next year everything goes to crap and you don't want to continue it, the policy will fund itself for a few years, first of all. But if you wanted to cancel the policy, you're out $4,000 instead of $15,000. So upside is a lot better. Worst case scenario, a lot better. So all comes down to policy design. Just remember that. That was a long-winded rant. Hopefully it provided you guys with some value there. Let's see. Let's see where are we at. I got to go back up a bit. You guys have been talking. At what interest range does it compound? What interest range do you pay to borrow against it? Depends on the company. So I'm responding to Andy's question. It depends on the company. So Penn Mutual, it's a fixed interest. You get 6% is what you pay to borrow the money, and they will credit your policy with half a percentage less than that. So 5.5% less. And those are fixed interests. It's not bad. You get a really good dividend rate that comes along with that. The policy has really good growth potential, especially long term, and you can put a lot of money into it for a long number of years. A lot of plus sides to that. Mass Mutual, two different options. You can go direct recognition or non-direct recognition. Direct recognition is a fixed interest rate. 6% is what you're paying. They will credit you 0.5% higher than the dividend rate. It's a great offer. And currently their dividend rate's 6.2%. So that means you'd pay 6%, you get a credit of 6.7%. That's before the costs of the insurance. So you don't actually see the 6.7, but it's a lot comparatively. Okay. Long term, what we see out of these policies, anywhere from 4 to 6% growth. So like over the course of the next 30 years, every dollar you put into this, by the end of that, you're going to see 4 to 6% growth. That's what we've been seeing. People that went through the 80s when it was a different interest rate environment, we had a lot of really high dividend rates. Those policies are averaging maybe 8 to 9%. Really, really solid growth. That's possible. We're in a really low interest rate environment, so we don't see that high right now, but it could change. But we always try and be realistic about it. The main thing is it's going to perform way better than anything you can get in a savings account. It's better than what you can get with an annuity. You get other benefits, such as the death benefit, and you have access to the money. So you're not just putting this money into something and not have the ability to use it. For a lot of people, we call it infinite banking because they're planning to use this as their own personal bank. They're putting the money into it, and rather than borrow that money from a bank later on, they're just going to borrow from themselves, knowing that they're going to, when they pay that interest, they're also getting credited. with something similar to that, if not more, or a little bit less. So that's what we end up looking at. Oh, and then with Guardian. Guardian is fixed interest. 6% is what you pay. 6% is what you get credited. You got insurance costs that come after that. That's a gross, not a net. Okay. Let's see. Why is it not recommended to borrow against your policy? Oh, we already did that one. Okay. What James just said could literally fund your retirement without making $1 in your business. Yeah, that's true. Andy, write off the interest on money you loan yourself. Yep, exactly. But you got to get with your accountant to make that work. I don't do accountant work, even though I did go through and learn accounting back when I was in school. I did that to do my own accounting, Actually, I've done all my own accounting for the last 20 years. So, do not know for the life of me why this is not taught in business. I think it's because there's a lot of incentive not to when it comes to the overall economic environment. Basically, people see it as a zero-sum game. Things have moved away from retirement or away from insurance companies where people used to always put their money in there. That used to be like the main savings vehicle until Wall Street came around. And now Wall Street is where all the money goes. All the money flows, all the advertising goes that way. Wall Street basically creates the laws these days. It's why we get state programs that allow you to automatically, or even sometimes they force you to contribute to a retirement plan. We have something similar to that here in Oregon. You're not forced to do it, but you have to opt out of doing it. Now, that can be a good thing. There's some good things that have to do with that, but that's not the only option that people should be left with. When it comes to teachers' retirement programs around here in Oregon, we have a third-party administrator that runs most of the school districts in the state. They kicked out all of the insurance companies that don't offer investing in the stock market as their main product. I didn't deal with that. When I was working in that arena, I was dealing with people that were on the verge of retirement, and it didn't really make sense for them to be fully at risk within the stock market. We had really good annuity products at that time that they could put their money into, and it would provide a level of safety that can help them out through retirement. And we basically got kicked out of being able to offer that in place of everything that has to do with the market. I don't know why they ultimately made that decision, but basically there's so much money and interest in pushing that I think that's what we see. And I think that's why you don't see that type of teachings in business or in school. Top Gun says it gets even better if you can tie your permanent insurance to a cash value life insurance line of credit. Yep. So you don't have to even borrow from your policy. You can go straight to your bank. So as a business owner, if you have a bank that you like to work with, not every bank will do this, but I actually did get a list of banks. I wanted to share with you guys. I'll have to see if I can pull that up. We were talking about this last week. I got a list of banks that do Helocs. So one of our viewers, I don't know if he's on tonight. CG. I forget the rest of your name. CG sent it over to me right during our live stream last week. He stumbled across a thread that was talking about this, and there was somebody that knew what they were talking about, has worked with a bunch of different banks. And what you can do is there's a number of national banks out there that have whole departments that will create a line of credit for you that your collateral is your cash value in your policy. So you don't even have to borrow from the insurance company. Your money can stay in the insurance company compounding while you're using a much lower interest line of credit than what borrowing from the insurance company would charge you. We're hearing like 2 to 3% lines of credit rates. That would be ideal for business, in my opinion, because it's a lot easier from an accounting standpoint for your business to have a line of credit that you can borrow and pay back against, funnel that money through without having to go through yourself. But yet you're using that personal policy that you're creating to increase that line of credit, to make money available. So it's just like you're using that cash value. You're still collateralizing that cash value, but you're getting a better rate. Now it comes with some hangups that you don't get when you go through the insurance company. We really like the ability to borrow from the insurance company because you don't have to pay it back. There's no set payback period. If you pass away at some point, it'll pay it back. It's really flexible, and they can't deny you it. You're guaranteed access to those funds. Whereas you apply for a line of credit with a bank, you're going to have to meet all of their qualifications. Now, my understanding is with these banks that have departments designed to loan against these, they know how safe it is, not quite as picky as they might normally be. So really good to look into. Just reach out to me if you guys want to see that list. I don't have it up now, but I did get that list and I'll send it to you. So send me an email if you'd like to see that list. It was a list of about 10. And I can add another one to that list as well that was not on the list. So, but that one is like Chicago area specific. All right, let's see where we're at. That was a great comment, Top Gun. So Andy, got to go. Thanks for this. Catch you on another live event. Yeah, maybe we'll see you tomorrow. I'll get on here tomorrow. JT, thanks. Need to set up a phone call. Do a Zoom meeting. Go to my Calendly. I'll put that in the chat again if I can. But the Calendly link is the best place to get on my schedule. You get to it accounts for the time zones, and it allows you to schedule at whatever is the best time for you. And if I'm busy, you won't see the slot available. So I'm going to put the link here in the comment section. So there's my Calendly. I would definitely suggest watch some videos first. I know you watched a bunch of videos already, but watch some of the videos that have to do with what you want to talk about, because I can help fill in gaps of any questions that come up. Things that maybe you're not quite catching how it's working. Sometimes this stuff takes time to digest and figure out how it works. For other people, it's like, holy cow, mind blown. How did I not figure this out before? Yeah, makes a big difference. But one of the things I'll tell you, dynamic banking is just offset accounting. Okay? Major companies do this every single day, and they've been doing it for decades. Offset accounting. People in other countries, banks allow them, when they make a deposit, when they have money sitting in their checking or savings account, that money is already automatically offsetting if they have a home loan or if they have a credit card or something else associated with that bank. It automatically offsets it. We don't get any of that here in the US because banks don't offer it. They keep people uninformed about it. So we've got to jump through a few hoops to make it happen in our personal lives, but we definitely should be making it happen. Other countries are ahead of the game on this. I don't know how they got to that point, but it's out there. But when it comes to those large companies, what they do is they have lines of credit that compounds continually. Okay? So specifically, my wife's grandparent worked for Walgreens. She worked for Walgreens for a long time. Wasn't it Walgreens? Payless? Rite Aid. Worked for Rite Aid for a number of years. And what her job was at the end of the day, all of the cash would come in. They would put it into their line of credit overnight. So they would get like 10 hours of interest offset. And then the next morning, they would pull it out of their line of credit. They would load up their cash registers for the day. And that's how they would have the ability to have cash in their cash registers, but they're maximizing the use when it's not needed. So every time they closed, all that cash would go up and it would offset the interest charges. And they would do that every single day, and it saves hundreds of thousands, if not millions of dollars, because they're working on huge budgets, huge amounts of money. We're not working with those big amounts of money, but it does make an impact, and it adds up every single month. So you may be able to save $20, $30, $40 a month just by offsetting interest on your regular paycheck. your business, if your business is putting through, $30,000 a month or $100,000 a month, you might be able to offset hundreds or maybe even thousands of dollars each month. But those add up because that's $1,000 that didn't go out to somebody else. And it worked to help pay down other debts, or it worked to start growing your wealth. So check into those things. It's amazing. It works, and it's simple math. It is not anything magical. That's why I don't charge anything for this. Some people charge $4,000 to sell you some software so that you can put in all of your debts and figure out exactly how to pay this stuff off quickly. You don't need to go and do that. It harkens back to that question that Poker asked, and I answered about knowing how to move your money. If you just figure out that you wake up, you think about where you need to move your money today to maximize it, you're automatically going to start doing this, and it just adds up. It makes a huge difference. Jones says, a lot of people lose money day trading. You seem confident you can get greater than 5% per year. How is it that you're so confident? Ignorance. That's the secret. So I'm having fun with it. I realize that there is a high likelihood that I will not do it successfully, but I'm willing to take the risk because I think I'm smart. I think I am going to spend the time looking at these companies. I tend to look and see how the movement happens. I mean, with Tesla, what threw me off, I was doing pretty good with it, but what threw me off was the announcement of a split when I had sold. Or when I was down, there was an announcement of a split. I didn't know what to expect. So when I made my money back, I sold, and it cost me $8,000. So there's no secret in that. Like, I totally screwed that up. If I had bought and held, I would have had a lot more money. Although I've kind of made up for that with my trades. And a lot of that can be attributed to luck because I'm no expert. I'm kind of feeling my way into this. But I have confidence in my abilities. But the reason I have that, I would say, is most likely ignorance on my part. I don't know what I don't know. And I'm also willing to take the risk. So, Top Gun, stock splits are no secret. Yeah, but when I first started, nobody knew it was going to split. Now, after it split, if you were paying attention to the company, you knew that there was so much upside. And by looking at and checking into all the videos, this isn't something that came out in the newspaper. The newspaper didn't come out and say, hey guys, Tesla wasn't a part of the S&P 400 before, and now they're likely to be included in the S&P 500, but the S&P 500 indexes don't own any of these stocks. They're going to have to buy 1.3 million stocks, or they're going to have to buy 131 million stocks over the span of a short day, or over the span of a few days. I didn't see that come out in the mainstream news, so not everybody knows about this stuff. But there's people on YouTube that are sharing it. And if you're looking for the information, it's out there so that you can take advantage of something that other people don't know. So I think where the advantage can be when it comes to day trading is to try and know more than some other people. Some people are going to lose out there. You're buying high, or you're hopefully buying low, selling high. You're competing against people that are maybe doing dollar cost averaging. So in that case, it could be a win-win because those people aren't paying attention to it day to day. They're going to look at it 10 years from now, and they're not going to care if they paid $10 more for it than you did that day. But if you're day trading and you got that $10 on not just theirs, but 100 other people, now you made $1,000 that day that they didn't. Okay? And hopefully the goal is you can keep doing that. I am not trying to advocate anybody gets into this. Day trading is not a good idea. Okay? I am not an expert on it. Like I said, ignorance has got me into it. I'm having fun with it because of that. Hopefully things will turn out well. I know at the end of the day, though, that I don't have to pay back that loan into my insurance policy. I don't have a bill that's due on that, so I can ride it out long term. I absolutely think Tesla is going to go up more than 5% a year. So that is an arbitrage move. Pulling money out of there, parking it in Tesla, total arbitrage move. Now, preferably, I want to put that into a retirement vehicle and let it sit for 10 years. But even still, some of that, I don't want to day trade all of it because you're going to end up paying taxes on that unless you're working inside of a retirement vehicle. So ideally, you want to let it sit for over a year, in which case you're paying that full 5% interest, unless through dynamic banking or other cash movements, you can pay that down when you're not in the stock. But what it does is it allows me to get in that stock when I needed to before that major growth. And I mean, we hit a ton of growth. So you have the ability to move money and take advantage of it. You're not going to see that all the time. That opportunity does not come around all that often, I don't think. Certainly not with a company that has as solid of a future as what we see in Tesla. So, I mean, I'm a big bull on Tesla, obviously, and I fully admit that. But I think in 10 years, it's a no-brainer. Tesla is going to be way up there. And a lot of that comes down to the fundamentals. What drives them as a business? There's so many positive things around that. And what I'll tell you what doesn't drive them as a business: short-term profits. And when short-term profits are not the consideration, I see awesome long-term growth opportunity. So 5%, businesses have the opportunity to grow way faster than 5% a year. And Elon Musk projects a possible growth of 40% a year. The projection a lot of people have on the stock is 30% a year. I mean, I think they've been averaging like 30 or 40% a year, something like that. It's something crazy. And then this year they're up, hundreds, like 900% or something like that. I mean, it's crazy. I don't know the exact numbers, but that was a solid bet, and I was glad I had the opportunity to take advantage of it. Okay, so next, let's go. Robert says, great explanation, thank you. Was thinking of having your main policy, $10,000 a year, max funded, and then if you want to borrow against that to have another policy that's smaller, say $5K, lots of options. That is an option. So if you're planning to start out small, that's a good way to do it. There's no, I know we've talked about this in previous videos, and maybe you were here. Me and Poker, we called it the Waterfall Method, where you have a policy that you get so much into it, and then there's a certain amount of cash value available in that, and as it is available, we can use that to fill another policy. That is certainly a way to do that. You don't have to necessarily start a new policy, though. I mean, it's great for me as an agent. I mean, I don't mind doing that because I get paid the most on your first year premiums. I get a little bit of residual on the policies for 10 years after that. But it's a tiny fraction of amount compared to what I get in the first year. Okay, and the way that we design these is obviously minimum charge anyways. So you got to put in quite a bit of money for me to get a decent paycheck from writing that policy. But it's still better for me to write multiple policies. But I'll tell you, you don't always have to start multiple policies. Sometimes you can just expand the current policy that you have. And by doing that, you can put more money into it. So when you're ready to expand, when you're max funding that policy and you're like, man, I got this money sitting around, I need it to work for me. I need to start another policy. That may not be the first choice. The first choice might be look at your first policy and see if maybe you can expand that one. Now there could be other reasons and good reasons why you would instead choose to start a new one. And that could be diversification. Maybe you didn't like the company that you started with the first time. Maybe you like a different option that's available in another company. Maybe you like a different loan option. Maybe you're diversifying that loan option. I like having policies. Some of them are direct recognition and some of them aren't. So I can borrow against them and I still have the opportunity to earn the full dividend. But I like having the comfort of knowing that if I borrow 6%, I know I'm going to get credited 6%. Like I can do a lot more with that, especially if I'm earning my gains outside of the policy. But if I want to try an arbitrage within the policy, I'm not going to turn that down. I like having that ability. So there's reasons why you would want maybe to have a few different types of policies. It also allows you to test out different companies. Some of them you can get money a little bit quicker. Some of them you can put more money in. The flexibility needs may be different. So your first policy, you may start with $10,000 a year because you're 100% comfortable having that amount available whenever the policy comes due. But maybe when you want to expand from there, you need more flexibility because that policy is going to serve a need for excess cash that you might dump in every once in a while. In that case, maybe we look at a different company that offers that kind of flexibility. There's all different kinds of ways that we can go with that. So, yeah, lots of options. Top Gun. How do commissions work with whole life? There seems to be less transparency than with IUL. My guess is it's the first year cash value drag. So, commissions with whole life. It depends on the company. It varies. It can vary quite a bit. Okay. Two of the main ones. I'll tell you about the main ones that I'm aware of. And there's probably things that I don't even know about as far as who gets paid. I'll tell you about my commissions. So when it comes to Guardian, I get 50% of the base premium in the first year. Everything you put in above that, I get 3%. So when we design these policies, we try and minimize that base premium, which pays me the most money, and we maximize the paid up additions above that, which pays me that 3%. You guys see that? That was my dog walking behind me. Mass Mutual. It depends on the product. I mean, different products pay different amounts, but it could be basic product 55% first year commission, and then 2% on everything above that base premium. Well, 3% on everything above that base premium, but after that, I get 3% a year. With Guardian, I get 50% the first year on the base premium, but then 10% for like the next 5 years or so after that. I don't even remember. I don't pay that much attention to the commission portion. It's kind of funny, but I can't even tell you the exact commissions that I make because I'm more focused on, am I designing the policies right? If I pay too much attention to the commission, then I think there's a chance that policies can be tweaked in order to not make it the most efficient. So I don't even pay that much attention to it. So truthfully, Penn Mutual. Penn Mutual, it's a good company, it's a good policy, but it absolutely pays the most commissions out. I think 90% in the first year, and that can vary, but 90% of the base premium. And they limit how much I can reduce that base premium more than the others. So on the exact same type of policy, one, I can't design them exactly the same, but I have to have a higher base commission with Penn Mutual, and then I get paid a lot more from Penn Mutual on that base premium as well. So Penn Mutual, I like it. It's going to pay me a lot more. It has its upsides, but I will never try and sell you on that without you knowing the downsides to it and if it matches your situation, if it matches what you're looking for. I don't let the commission dictate whether I sell it to you or don't sell it to you. So for the most part, I wouldn't worry too much about how much the insurance agent's getting paid. We all need to get paid for the work we put out there. How's the policy going to perform? That's what it boils down to. And despite paying me a lot, the Penn policy, it produces. I mean, it has good cash value growth, even despite that. But it needs to be designed correctly. Okay? It's really easy to design some of these policies so that it pays me a lot more money. Other agents will design policies that way, and they try and justify it. I don't see the justification. When I put these policies up side to side, and if you're on YouTube and you're familiar with IBC Global, Steve, who I work with, I go through him for Guardian and Mass Mutual. He really goes into depth, has a lot of spreadsheets that he shows, and he shows you exactly when we design these policies with the way that we design them, you can't compete with it if you increase the base premium. It just doesn't compete. They can point to certain numbers, maybe the actual dividend payout is higher, but the overall cash value is higher with the way that we design them, regardless of what the dividend says it's paying out. So don't let that distract you. Just look at the bottom line. How is the cash flow working out? Okay, is dynamic banking useful for paying student loans? Absolutely. Dynamic banking is useful for paying any debts. Any debts can be paid much, much quicker if we do that. Case in point, we do what's called paycheck parking, which is how we get that offset accounting. That's like the key to offset accounting. That means any income that you get, you put it right into your line of credit to offset those interest charges. Meanwhile, you're putting chunks towards those debts. So you put a chunk towards your student loan. What that does is you knock down the interest charge on your student loan really quickly. Okay? Doesn't really matter what the interest is. You're going to knock down that principal balance, and when the principal balance is lower by that larger amount, you're going to pay less interest. Not only that, you're going to immediately pay less interest on your student loan, but now you're going to put your paycheck into that line of credit and offset those interest charges. And if you do it, you could do large chunks or you can do small chunks. If you do small chunks and your paycheck offsets it almost completely, not only did you reduce the interest cost in the student loans, but now you're also paying almost nothing in interest on the dynamic banking side with that HELOC. So that's how we get multiple savings. Okay, your savings add up beyond just what you're saving with that offsetting interest over here. And if that saves you $20 that month, and we're putting all of our money through these, okay, that gives you $20 extra the next month. So what happens the next month? You add that $20 to the $20 you're going to save that month, or you might save $20.10 that next month, because it's going to compound. The savings are going to compound. So you add that $20 to the $20.10. Now you're saving $40 every single month. The next month after that, now you're up to $60 a month. And you're just going to keep repeating this. We're snowballing all of this into your debts or into the cash value growth in your infinite banking policy or wherever you want to put it. I was talking to somebody else who wants to do some lending, and using a company peer-to-peer lending type situation, they could chunk. They don't have any debts that they can have to chunk at right now, and they've already maxed out on their policy. So when they do their chunk, like, put it into an investment, put it into a peer-to-peer lending, make it start working for you. You're going to offset the interest charges on it over here right away. So you're basically playing with house money, and you got it in an investment. There's all kinds of things that we can do to make this useful, but you just know that month to month, all of these savings add up, and it just snowballs. Did I get more shares? I did not get any more shares after close today. You saw Kathy Wood shorting it. Oh, isn't shorting it. Is that what you said? Isn't Kathy Wood shorting it? I don't know. I haven't heard. I haven't been paying attention to it. After that long live stream, I basically did a little bit of work around the house, and then I got ready for this live stream. So I'll do my research. I actually have some work to do after I get off of this. I've got a few illustrations I've got to create. I got a few policies that just got approved that I need to finish the paperwork on that so it can get started. And then if I have time before bed, I'll do some research. Let's see. Chasing waterfalls. Nice. I like that. Robert says, life insurance question. Okay, I see a lot of the Nelson Nash practitioners hate that more and more agents are selling 1090 policies. They say, number one, it's not true to what Nelson taught. Oh my goodness. And that eventually interest rates and dividends will grow in the future, creating a long-term drag on policy designed for cash. Absolutely not. I totally disagree. Okay, so point number one, it's not what Nelson taught. It's like they're creating a cult around this. And Nelson Nash is the god. He can do no wrong. This was something that he started doing over 20 years ago. Okay? Well over 20 years ago. Nobody knew. In fact, I don't even think you could design policies the way we're designing them today, 20 years ago. Okay? They did not allow us to blend them the way that we're blending them now. So he was used to being able to create policies where 2/3 of it went to base premium, 1/3 you're able to do a paid up addition. They didn't have the blending. They didn't have where we can blend term with whole life and maximize that cash value. Now he's alive. He was alive when that came about, and you're able to do that, but they resisted it for some reason. Why do you suppose that is? Well, if I design a policy that is 60% base premium, if you're putting $100,000 into that policy, I'm going to get paid uh, probably, close to $60,000 in my first year's commission. I like that a lot. There's a big incentive for me to design a policy that way. And if we're creating an atmosphere that's cult-like and people get sucked into it and they think, oh, we got to follow Nelson Nash, because what's evolution? These policies can't possibly evolve to do something better. We have to do what the original person did. That's kind of the way I see that. Okay? There's no reason to not take advantage of the evolution in life insurance. Life insurance took a big hit when everything shifted towards Wall Street. Okay? Life insurance companies had to adapt. Life insurance companies had to evolve. Their products had to get better. That's the key here. Their products had to get better. And insurance agents, some of us, want to make sure that, and we know that if we design them the absolute best way that we can, they sell themselves. We don't have to put a lot of effort into it. I don't go door to door and sell these things. I don't make phone calls to sell these things. What do? I put out educational videos on YouTube. That's the only thing that I do. That's the only thing a lot of these folks do. They don't do a lot of some people pay for advertising. You may see some advertising on my channel, which is somebody pitching that. They're trying to buy a customer. And they're using a video that teases you with some information. I don't think they give out all the information, at least not the ones that I've seen. I don't do that. I don't put any money out there. I grew this channel over 2 years. I could have grown it quicker if I threw money at it, paid for marketing. But those are not really, that's not really my target market. I'm not trying to get people hooked on an idea where they don't actually know it. There is a process that I believe people have to go through. There needs to be an education period. That's what these videos are designed to do. When people learn how to do it, they're going to see how it can be used in their life, and they're going to come ask about it. And if they want to come talk to me about it, I welcome it. If they want to talk to other people, go for it. You got to figure out who's going to work best with you. Not everybody is detail oriented. Not everybody wants to see all the detail that I provide. Some people are more than happy getting caught up in the emotional aspect of it, that cult-like atmosphere, I should say, where some of these practitioners, they don't want to show you all the details. In fact, it annoys them when you ask for the details. That bothers the heck out of me that they dedicate a lot of time to complaining about problem clients. I see a lot of clients. I think partly it's because of how I design my videos with so much detail. It basically attracts people who like to see the numbers and like to see how it works. And those are the people that are going to go to those other folks, and they're not even going to want to hardly bother with you because you ask too many questions. And when you look at the numbers of how they're going to design those policies, it's not going to match up. It's not going to make sense. And they're going to waste their time with you, and they know that. That's what I see happening. I'm not trying to crap on those people. Regardless of if you get in with those policies, they're designed well enough, you're going to succeed, I think. Okay? I wouldn't worry about that. But what is my channel about? Maximizing your cash flow. It's not let's do good things with your money. Right? We're not just trying to do okay. Let's do okay with our cash flow. Who wants to do okay with your cash flow? Me, I want to maximize it, and I want to help you maximize it. And to do that, we've got to design the absolute best policies that we can. Okay, second one. Interest rates and dividends will grow in the future, creating a long-term drag on a policy designed for cash. No, that's not what I see. So what happens, a lot of these people sell Penn Mutual policies. I'll tell you that right now. And remember what I said about Penn Mutual? They pay us a lot of money. If I design a Penn Mutual policy, let's say I design a Guardian policy at $100,000 and I design a Penn Mutual policy at $100,000. I can design a Guardian policy, 10/90 split. Base premium is going to be about 10 grand. Means I'm going to get paid somewhere a little over 5 grand. Probably, well, maybe close to 10 grand after I get all the excess, right? Penn Mutual policy, and this is not to say that Penn Mutual is bad, but the best I can design that policy is a 20/80 design. So I'm going to see, and then I get a 90% instead of 50%. I'm going to be over $20,000 in a commission with the best design policy. Now, it's going to perform over a few years. It doesn't take very long to catch up because it illustrates with a higher dividend rate. It illustrates really well. And if that dividend rate keeps paying out high, it's going to perform. So I have no issues selling you that policy as long as we design it the best way that we can and it's going to meet your needs. But I make way more money selling that policy. Now if I say, well, 80/20 design, if the dividend rate changes in the future, now keep in mind we're in a low dividend rate environment, and it might be 20 years that we're in this environment. Who knows how long this environment will last? I mean, the way that our government is ran, they're never going to be able to raise the interest rates because they're always chasing a phantom economy that we just can't reach. So the way, and they tend to make decisions that benefit all the people at the top, which makes it so that the only way to stimulate the economy is to keep giving breaks to those same people at the top. They have not tried getting that money into the hands of people at the bottom, which could stimulate the economy, lead to some inflation, which is good. We want to have a little bit of inflation. It's healthy for an economy, helps pay down debts. But they're not doing that. So I don't anticipate this interest rate environment changing for a long time. So am I going to design a policy for you that is now a 30/70 design that'll pay me $30,000 on that same policy design in the off chance that 30 years down the road you're going to start to see some higher dividend rates? That may change how that policy is going to perform, and it might do better. Or am I going to do a policy that's designed the maximum that I can do it, either a 90/10 or an 80/20 design that gives you more cash value in year one, and if we stay in this interest rate, if we stay in this interest environment, is going to give you more cash value 30 years down the road? Or do we want to guess? I mean, we're going to have to make some offsetting decisions here. I'm going with the first option. First of all, when we do that blend, that term insurance does not hang around forever. So the risks associated with that term insurance are very short term. When it comes to Guardian, it's typically about a 7-year design. Somebody just recently did a Penn Mutual design where they designed it to stop being paid. Premiums stop being paid in 7 years, and another one that gets stopped being paid in 3 years. If we're stopping paying premiums and we're going with that type of design, it's not going to matter if you paid higher base premiums on those first few payments. It's not going to matter down the road. Your cash value difference is going to make more of a difference. And what we see, if you watch Steve's videos, he does a really good job demonstrating this. Steve Parisi with IBC Global. If you watch his videos, he's the one that taught me how to do these designs, by the way. So that's why I'm mentioning him. I work with him. I go through and I sell Guardian and Mass Mutual through his company. I'm independent of him, though. He has people that works in-house. I'm independent. But he still gets a little percentage of the work that I do. But he shows the designs that the dividends may be higher on those higher base policy designs. The dividends may be higher down the road, but the overall cash value is more on our designs. So does it matter to you if you see that a dividend pays more or that your bottom line is more? That's what it comes down to. So you just got to get some illustrations from everybody and make that decision. That's basically what it comes down to. Double check everybody, get second opinions. But bottom line, you're going to have to make a guess. What is the long-term interest rate environment? How long are you planning on funding this policy? And really, we're just trying to do this the best design for whatever situation you're in now and the best guess that we can make. Let's see. Interest rates and dividends will grow. Oh, yeah. Okay. So hopefully that answered your question, Robert. You got another one? I'll get to that one. Jones says, you just talked about chunking and dynamic banking. Is there an optimum chunk amount, or the bigger the better? It depends on what you're doing. If, let's say, you're paying down a house If you're paying down a mortgage and the mortgage has a really high balance, let's say you just started, you got 30 years. If I put the numbers in, it's going to depend on what the interest rate is on your line of credit. But even if you're paying a higher interest on your line of credit, you will overall pay off that house quicker and pay less interest on both of those loans if you do a larger chunk. If there's a different situation, let's say the interest rate on your line of credit is a lot higher, you may not want to do larger chunks. Even on your house, it may not make sense, but we can go through those numbers and figure out. There are calculators out there that we can use to do that. None of them are ideal, and you may have to pay for that. I usually just do a brute force method. I don't have any special, I haven't made up any special spreadsheet that I can sell you guys. You can plug these in. I just do the math. But there is a way that you can do small chunks where you're basically keeping that balance really close to zero throughout the month. As close to zero as you can. And in that case, you're saving the most interest on the line of credit, but you may not be saving the most interest on the thing that you're chunking out. So it depends on what that is. It depends on the interest rates you're paying on those. If it's a high interest, let's say it's a high interest credit card, you're much better off throwing a large chunk at that and having low interest line of credit now that you're paying. The questions come in, and the determination where you're going to have to make some decisions is when the interest rates are switched. When you have either the same interest rate or higher interest rate in your line of credit than you do in the debt that you're trying to pay down. Now, the other question is, too, what do you have for an emergency fund? How much of this line of credit are you using as an emergency fund? I like to use a line of credit to supplement my emergency fund of quick, accessible, fast cash. I keep a little bit of cash on hand, $1,000 or $2. I keep a few $1,000s in my checking or savings account, and then I rely on, when I have my line of credit, which I've already told you I don't have right now, but when I had it, I rely on that space in the line of credit to meet any other needs that I have at the time. I don't let any other cash sit idle. Those other things are idle cash. I don't want to do that with very much, but there's an advantage to having access to quick cash. If an emergency actually comes up, if that emergency is maybe we've got a power outage and I've got to pick up emergency supplies, I'm not going to be able to access my bank account. Okay? I'm going to have cash on hand so I can meet an immediate need. But not all emergencies are that immediate. Sometimes I might have an hour or two, in which case I can go to an ATM. I have time to go pull it out of the bank. So I have some cash to meet my immediate needs that in the extreme situation, I have to have cash. I have another little bit that's available electronically if I need it. And then I have a larger chunk available electronically in the Heloc that's available, or the line of credit that's available. The rest of it I have in my life insurance policies, as much as I can. Much as I can have in that. And then others I have in my investments. So we have different buckets. But as far as emergency funds go, the rest of that emergency fund is in my insurance policy. Because that's where it's doing the most work for me. And I know I have access to it in 2 to 10 days. Depends on which carrier I have that money in. Mass Mutual takes me about 10 days to get access to my money. Guardian, 2 to 3 days. Now, of course, that's not counting weekends. Those are business days. National Life, couple of days. I'll find out here real soon how quickly I can get it out of Allianz, because my Allianz policies are going to be starting any day now. And of course, I'll see how quickly I can get that cash as well. But you can be sure I'll share it with you. So hopefully that answered your question about chunking. Watch the videos on it. You can see I do some videos where there's small chunks. I think I do some where there's bigger chunks. I haven't done those videos in a while because they weren't getting a whole lot of views, but it wasn't so much that as I realized overall it's more of a mindset about moving money. You don't actually need to figure out the exact numbers, although in the situation you're asking for, it's good to see those numbers, but I've already got those videos out there. So hopefully you can see those videos and get that dialed in. But if you have any questions after watching that, just sign up for a meeting with me. Hit me up on Calendly, and we can go through the numbers, figure it out. Robert, that's what I was thinking as well. For a lot of agents, it's going to take a hit on their commission check. Yeah. And now here's the thing. It's for a lot of agents, it's not just that drives it. I really believe that there's agents out there that want to do the best by their client, but they don't know how. They are not taught that. If they're a captive insurance agent, you can bet that that insurance company has not taught them how to design these policies to maximize the value to you. If they're with an IMO company that they just on the phone all day, just selling clients, that the leads are given to them by the IMO, they're not going to teach them how to do that. So it's a lot of it is just a lack of knowledge. There are some people out there who would all day long put their interests over their clients. Hopefully you can identify those people and stay away from them. All right, let's see. Also in Nelson's day, dividend rates were really high. Yeah, the dividend rates were way up there. I think 8%, 10%, 12%, something like that. I think in his book it was like 8% average. You could put in a whole life policy. You could put $2,000 a year away for a kid and have that grow into a nice big chunk of money. You do that in today's policies, and with a whole life contract, it's not going to grow that much. I mean, it's going to be okay, but it's not going to get very big. Nothing like what he saw in his policies and in what he demonstrates in his book. So while I put that book out there, it's not to go off of the illustrations that he has in those books. And he often wishes he didn't put those in there because those dividend rates are no longer available. And so it's kind of misleading. However, you can potentially see that type of growth with a kids policy in a nice IUL. And that's what I look for. I look to put my kids in those IUL policies because you're working with an insurance product that the underlying cost of insurance is really, really low. It's a lot lower on the IULs than it is on whole life. And they have such a long period to take advantage of those low rates when the stock market can grow, those indexes can grow. You have a much better opportunity at getting 8, 9, 10, 11, even 12% returns over the long term in a policy like that if the stock market performs. Now, there's not guarantees that come along with that we get in the whole life, and there's an important reason that we like to have those guarantees. And I need to put a video out on this, but when it comes to your kids, they are not going to qualify for the best rates. They qualify for juvenile rates, which are often the equivalent of standard non-tobacco rates. So when they get older, you can 1035 exchange them into a whole life policy if you want to. You don't have to start with one when they're young, and you can try out an IUL and see if you can get those gains. And if you get those gains and you decide the whole life is the product you want to be in, we can roll those gains into it, no tax consequences. The insurance costs were minimal, so it doesn't matter if we roll it into it. You're going to have gotten the gains that you could, and then you can get into a whole life product with the top health rating, hopefully, and get the maximal use out of that, knowing that you're going to have life insurance for the rest of your life. The small risk with the IUL is that the cost of the insurance grows in old age, and it grows to an amount that's not affordable. With how we design them and the way that we talk about funding them, it is very, very unlikely. And the way that I design them, we design them for minimal insurance costs. And when you get older, it's only after you get older that that insurance cost really jumps up on those things. And if we manage how much insurance you're paying, maximizing that cash flow, you're not going to need that insurance, then it won't matter. You can keep that policy until you pass away. You're not going to encounter those tens of thousands or hundreds of thousands of dollars cost of insurance if we design it properly and we manage it properly. Okay, so let's see what's next. So Tesla, up or down tomorrow? Ooh, good question. I don't know. I got to wait and see. I don't know if you saw it in the aftermarket. It popped up a couple of times. It depends on who's buying and who's selling tomorrow. Are we going to see Tesla start to sell their stocks? If we do, we might see a lot more sales. And most likely, so the agents that Tesla has tasked with selling those shares, those agents are going to earn 0.5% commission. Are they going to care if they sell the stock at $500 or $450? Probably not, because it comes down to time. How much time are they going to waste of theirs trying to maximize a $50 amount there? $50, 5% of that, what's that? $2, not even $2.50, 25 cents? I might be off. Let me do the math here. 50 times 0.05%, 25, maybe even 2.5%. I think I went too far down. I did too many percents on there. 250, let's say. It might make a $2.50 difference. Are they going to waste all day trying to earn an extra 250 on that share, or do you think they're just going to sell it and move on? I think they'll just sell it and move on. I don't think they're going to care that much. So when Tesla puts out an order to sell, you might just see those stocks go, dumped on the market, and the price may go down. That may push the price down. If for some reason they do, I mean, Tesla does have flexibility in what they get for those shares. So Elon could say, hey, put this out there, but I want to get this much per share. Now maybe it'll force them to slow play it into the market, in which case maybe it won't push the shares down because they're not going to sell. They're not going to be able to sell it otherwise. But that may not be an effective raise of money. In fact, now that I think about it, the stipulation that Elon put in that allows them to unleash those funds at any point in time, they get to choose when and how much, that could be directly tied to being accepted to the S&P 500, and maybe he wants to put those out as soon as those index funds have to buy. So that might be a behind-the-scenes agreement that Elon has with the S&P 500, because often the S&P 500 will talk to those companies and ask them to release extra shares, making it easier for their index funds to get in and buy them. So that could be a possibility, something that's been on my mind and I thought about. Let's see. You hope to see me do an illustration on premium financing very soon. I'm probably not going to do that. I don't really get into premium financing. There's a number of reasons for that. I mean, one, I haven't sold any premium financing cases. Insurance companies don't really like them. I've been listening to some people pitch them. I know there's some companies out there. I have some contacts of private money lenders who engage in that. They mostly deal with index universal life companies. Premium financing is mostly tied to index universal life, and you don't get guarantees with those. There's a good possibility, but you may have to come in with some collateral as well. So from everything that I'm seeing when it comes to premium financing, it's targeted at people who have a lot of money. You got to have at least $1 million, probably more than that in the bank in order to qualify, first of all. You're talking, yeah, there's a major advantage to doing it, but you only have a limited amount of insurance that you can buy as a death benefit. So far, nobody I've worked with has $50 million. They're not going for a $50 million policy. A lot of those premium financing cases are targeting really, really rich people who have a lot of money like that and can get a really high death benefit like that, but they don't want to pay the premium that might require. They're not looking to start an infinite banking policy with that much money. They're willing to take the risk that an IUL comes with, and they have easy access to the collateral that requires. So for a lot of different reasons, that's why you probably won't see that. If for some reason I happen to come across one, I'll try and record it. I mean, if I happen to do one for somebody, I will try to take notes and put out a video on it. It's not really my target market. My target market is more to help people that are working out, that are on their way up. I certainly wouldn't turn away helping out somebody with a lot of money because it's an easy way for me to make good commissions. But commissions isn't driving me. Like on a premium finance case, I've seen examples where an agent can make like a $250,000 commission. Now, first of all, they don't design those policies optimally either, from what I've seen. In fact, the company that was pitching it was like, if you're in a competitive situation, you can design it better, but you're going to cut your commission from like $500,000 on this policy down to $250,000. And I'm thinking, I could cut my commission on that policy, design it even better, and it would probably be like 100,000. And I'd be really happy with that design because that's way more than I've gotten on any policy I've designed currently to date. Much less collateral would be required of the client, much greater chance of return on the money, and but they're not even designing them that way. They're designing them for big commissions. So, I mean, almost none of that goes towards what I'm trying to do. So anyways, that's why you want to see me do it. Well, if somebody out there, if you're a very high net worth individual and you would like to see something like that, talk to me. I'll see if I can design it. But it may take me some time. I'd have to contact the right people because I'm not set up with any of those folks to be able to do that. But if you're looking to do that large of amount of money, there's no reason to rush into it anyways. You bet I could do it better than the other guys. Yeah, I mean, I would guess that they have the ability to design it the same way. I mean, I don't really do anything special except try. Okay, Robert, last question. You may go to with a policy for Mass and Guardian. Is it true that with Mass you can fund a policy much longer with the term rider attached to it? Yes. With Guardian, it's only 15 years max. Yes. Not necessarily 15 years max. That tends to be what we see with Guardian. And a lot of that comes with how those policies are designed. With Mass Mutual, they have two different riders that we attach in order to maximize that cash value in the first year. The way that those get paid down, it still functions similarly to Guardians in that every time you make an extra payment on it, it's going to burn off some term premium. And once that term insurance is completely burned off, you can't deposit 10 times the premium anymore. But because Mass Mutual has these two different ways of getting that blend, it reduces let's say you put an extra $50,000 into each policy. Rather than it buying $200,000 of paid up additions and it reducing the amount of extra term insurance that you're buying by an equivalent amount, what happens is Mass Mutuals, it starts off with a lower death benefit, and when we get those paid up additions, it adds to the death benefit, and it only reduces that blend by a little bit. And so we can stretch that out for almost the whole life of the policy if you want to fund it for a long time. The only downside is Mass Mutual likes to know exactly how much you want to put in each year. And if you want to put in more than that, you got to go through underwriting. So it's a little bit harder to get a really high dollar value policy approved unless your income can support it. With Guardian, the way that we blend theirs, you start off with a higher death benefit, and every time we pay a paid up addition, your cash value is going to catch up to it. Your cash value is going to catch up to it, and the term insurance reduces. So your death benefit stays level, but the amount of term insurance gets reduced as the cash value goes up. So your term insurance is this spread right here. Okay? As this goes up, that spread gets lower and lower, and as soon as those cross, no more term insurance, and we can't 10x the premiums anymore. At that point, your policy, the money that you put into the policy is not as efficient. It still works good, but you can't put in as much. So not only is it a little bit less efficient, but you can't put in as much. It reduces how much you can put in. That's really great for people who just have a short funding period. We have a lot of people that only want to fund for 7 years or 10 years or even 15 years. And so it works out good for them. And maybe they want that higher death benefit right away. With Mass Mutual, that death benefit jumps up really quick because you're paying those paid up additions. But it starts off smaller. They allow us to jump it up, but it starts off smaller. So hopefully that answered that question. And so with Guardian, I mean, there's a limit on how big of a death benefit we can attach to any of these policies. And it's typically, with Guardian, it's 10 times the amount of the base premium, or 10 times the base face amount of death benefit. With Mass Mutual, it has to be a 3-to-1 blend. So our base premium, we can design it to where the base premium is still, you can put in almost 10 times as much of it, although it's that's kind of a hard number to get to with Mass Mutual. We don't see quite a 90-10 design there, although we can see a 90-10 design with actual cash value. What turns into cash value? We can get really close to that. I think we end up in the range of like maybe 87% or 84%, something like that. But Mass Mutual does have a high early cash value product, which we can get up to 95% cash value in year one. Really, really good design, but there's a trade-off. The costs are different. The costs are a little bit higher in that, and it actually reduces your long-term cash growth. So if we put it side by side with a policy that's the L100, let's say with Mass Mutual, if we do the high early cash value L100, we design them the same, we get much quicker early cash value, but the long-term growth ends up being less than the L100. So we just look at that and decide which one works best for you. So I'm working with somebody who decided that the early cash value is the most important thing. So we're going for the high early cash value product to try and get 95% available. He's a real estate investor, and the difference to him could mean that having access to enough cash to make a real estate deal that could be, I mean, you could get, 30% returns or 100% returns, or, the amount of returns that's available to him on investments outside the policy dwarfs anything that he's trying to do within the policy. So for him, that was the most important thing. For other people, if you don't necessarily need that extra money, in this case, the difference between 87% available and 95%, it might have been like, $10,000 in the first year in cash value. To him, it was worth it to have that extra 10,000. For other people, you may know that you don't really need that in the first year. As long as you have access to most of it, you're okay. And you'd rather have those long-term growth. So we'll just design it to fit whatever your need is. Holy cow, love listening to you, and you can talk. Left for about 35 minutes, came back, and I'm still at it. Drink some water. Oh, good idea. I'm almost out here. Glad you're enjoying it. And these are awesome questions. I love getting into this stuff, and you guys are asking some good ones. What time is it? 8:14. I'm probably going to have to finish up here soon. Let's see. We got to save some stuff for next week. So, Top Gun. That's why you want to see me do it. You know I do it right. Hope to be your first client for premium financing. Okay. All right. Well, if you come to me and that's what you want, you got to come tell me, set up a meeting, and I'll figure out how to make it happen. Why can't you use whole life for premium financing? I think you can. I think there's companies that will let you. I don't know why they don't do it, except the growth potential is so much greater in an IUL. And a lot of people that are doing that premium financing, they want that growth potential. You're talking way more insurance. So when you get to old age, we can't reduce. You're going to be paying a large amount for that cost of insurance. But if it's performing, it won't matter. If it's performing, it won't matter. It's going to make more than enough. If it doesn't perform, though, that's where it can come into problems. So I do like that what a whole life provides. And in this case, I think that Penn Mutual product is actually a good whole life product. When you compare their IUL, Penn Mutual offers an IUL and a whole life. When you compare the performance return on both of those, the actual long-term growth, the whole life doesn't match the IUL, but it's pretty close. I mean, it's got pretty good returns. I would feel okay doing that, although you would have to qualify for a ton of life insurance, death benefit. The way that Penn Mutual calculates the amount of death benefit, they don't take the amount of death benefit we're starting with. They look a few years down the road. And so if you're putting a ton of money into this policy, your death benefit, even though it's starting out really high, it's going to go up from there. And so you're going to have to qualify for that much higher amount. Whole life policy, the costs of that insurance are higher than in the IUL. So if you're starting out, hopefully relatively young, 40 to 60 years old, the cost of insurance is still relatively inexpensive, definitely less expensive than a whole life policy. You have that opportunity in an IUL for that arbitrage if the stock market performs. The only downside is we got to see that performance in the stock market. You do have that slight level of risk. Okay? So something to be aware of. Oliver, your mother is close to giving up her car due to over 250,000 miles, in which you will be giving her your car. You will then be in the market for a car. Do I suggest leasing or buying? Oh, good question. It depends on what your needs are. If you do a lot of driving, it can be hard to meet those needs with leasing. If you do buying, are you looking at new or used? Are you open to new or used? If you're looking at buying, I guess it also depends. So what I look at, I got to look at the whole financial picture. When we consider buying a new car, you have the opportunity, and I discussed this in my ATV, cash or loan, or policy or bank loan. But what it comes down to is, do you need access to the money? Would you like to have your equity in your car paid off? Would you like to have a low payment and have that extra cash flow? Or would you like the cheap money that's borrowed out there, buy a new car, drive it till it's dead? Either of those two ways, whether you buy it used and you drive it till it's dead, or you buy a new and drive it till it's dead, odds are over that whole time, the cost of ownership could be similar, as long as you buy a good used car and not a lemon. The cost of ownership each year could be fairly similar buying the vehicle. But you're going to take a hit in the early years. And you're going to hurt your cash flow in the early years on that. So where is the value to you? You said your work's 2 miles away. You're looking to new car. The car you're eyeing is around $42,000 without negotiation. Okay. How are you planning to finance it? That would be my next question. You'll technically be a first-time buyer, hoping some negotiating will work out. More than likely, you would lease. Since you won't go past the 10 to 12 miles. So many decisions. Okay, with a vehicle that's $42,000, it might be a good idea to lease it, because you're going to go in there. I don't know what kind of vehicle it is, but you're going to go in there and you're going to find out what they're going to guarantee the cost is at the end of your lease. The advantage to a lease is you have a guaranteed buyback amount. When you get to the end of that lease, if you have not driven it 10 to 12,000 miles a year, maybe the used car market is strong, it's possible that your car is worth more than what the guaranteed lease amount is. In which case, before your lease is up, you try and sell it on your own. If you could sell it on your own for a higher amount than you have to pay to the leasing company, and then you make a little bit of money, offset some of your cost of use. I don't know a whole lot about the Audis. Long term, I think if I recall, they have a high cost of ownership because parts and mechanical work is expensive on those. I don't know the reliability on those. You might look up cost of ownership per year. Nice car though, but I don't know the cost of ownership. So check that out. That will also factor in to what you're looking at long term. The advantage to the lease is you know your set costs. You know what it's going to cost you every month. Oftentimes you can get a policy, or your warranty will be covering any other costs. So it's really easy to dial in, as long as you don't end up with a lemon that's in the shop constantly, or it's costing you money that way on things that maybe aren't covered by the warranty. But if there's a good warranty on it, a lease could be a really good option, especially at that high of a dollar amount. If you're talking a cheaper car, oftentimes it can be good to just find a used one. A couple years old, save a whole bunch of money. Even that one, $42,000. You might look at a used one, and maybe you find a used one that's $15,000, $20,000 less. In which case, it could make sense to buy the thing, and in the normal time where you would lease it, how much are they selling for that many years down the road? So if you're looking at, let's say you find a 2018 model, very similar, has all the features that you want, in great shape, saves you $15,000 off of the brand new price, and then I would look 5 years down the road or 3 years down the road. How much are the 2015 selling for? What's that price difference? Because that will tell you about what your cost of ownership could be in those years. And it could be less overall. So a lot of things go into those decision making. Sometimes we just like to drive new cars, in which case, yeah, maybe look hard at that leasing. It doesn't tie you in long term on a big $42,000 debt. You know the exact cost over those few years, and you can plan on another purchase in 2 or 3 or 4 years, however long your lease is. So hopefully that helps. Sage wisdom on car buying advice. Hey, I used to be a car salesman. I mean, that was like 20 years ago, but I learned a little bit back then. Use an IBC policy to buy it. That is an option. Definitely can use an IBC policy to get it. A lot of Nelson Nash would recommend doing that. Get the bank out of your life. Now, for me, banks offer really cheap money right now on new cars. New car companies offer really cheap money on new cars. And you can often get 0% or 1%, 1.9%, as long as you're not paying extra premium on the actual cost of the car to get that reduced rate, which most of them I don't think you are. It is something to check into, though. Negotiate a cash price, see what you can get getting a loan. Sometimes they'll give you a low price if you are doing financing through them, because they get an extra bonus if you're doing financing through them. They make money on every stage of that car transaction. So might be something to look into. But you can always have the cash value in your IBC policy to pay it off whenever you want to. And now you're putting that equity to work for you. You have a lower cost loan, and you're getting that arbitrage. Just depends on your needs, but I go over that in that policy loan or bank loan ATV purchase video. So check that out if you want to see more on that type of decision making. Let's see, your current car. Oh, we did that one. CX-5, Mazda CX-5. Oh, those are pretty nice. 37 miles on it. Quote is 19. Is that to turn it into the dealer? Are you leasing that car, and do you have to turn it back in? Tell me a little bit more on that vehicle. If you're leasing that car and you got to turn it back in, I'm assuming that's the buyback amount at $19,000. If you're not leasing it, I'm assuming that's probably trade-in value that they're giving you. And you might consider selling it on your own. You can usually get more. It just depends on how much time you have. But it's a pretty decent used car market out there right now. Fairly decent values. I know somebody was looking at CX-5s trying to pick one up, and there was ones in that range, CX-5 or CX-7, with like almost 200,000 miles that were going for like 10 grand. It was pretty crazy. So something to consider. Christopher, just tuning in. Going live tomorrow with Tesla? Yes, I am. I will see you guys in the morning for that. I'm going to be off Friday. I'm going camping. So I'm not going to be available Friday, but I will do tomorrow. Got to hopefully get some trades in, because I'm not going to be around Friday to see what happens. If I'm out of town, I'm going to be out of sell range. So if they announce the S&P 500, I am going to not be happy at all. So hopefully I make some changes. Although I don't plan to be out of the product on Friday. So I'll still have those stocks. I'm definitely not going out of town and out of sell range without having the stocks. So I guess on the flip side, I hope it doesn't crash while I'm gone either, and I totally miss the opportunity to get out of it. Richard Mullings, been using Steve for years. Love the Guardian policies. Use it for real estate investing and lending. Nice. Steve is awesome. I love that guy. Steve, he's the one that got me into this, and he taught me how to design the policies originally. He knows more than I do, frankly, about this stuff, but he's so busy. If you go to work with him, you often end up working with somebody else. So I've had a number of people who've worked with some of those other folks, and then they work with me and they want to actually work with me instead. And Steve doesn't mind. Like his outlook is the same as mine. It's all about the client. Now, I don't pursue his clients, but sometimes they sign up to have a talk with me. They watch my videos. They want to work with me. They're really detail oriented, which I think is what attracts them to Steve and me in the first place, is because we dive into those details. But I'm a little bit more accessible these days, I think, than Steve is, but he's awesome. I'm glad you work with him, and it's good, because he is a good guy. And his number one thing is transparency, getting the information out to you, helping you make an educated decision. He's persistent when it comes to follow-up, which is awesome. I don't do follow-up. I don't try and push. I'm not a pushy salesperson. I call it pushy, but like when he pursued me to get me on as one of his agents, you kind of see it as pushy, but I call it persistent. He was not rude about it at all. He was like, I want to get you the information out there. Don't let me forget. There's a bunch of different ways that he contacted me, and it was like, it works. It works. I'm doing so much. I don't have the time to put that in, and it's just not part of my nature to pursue clients that much. So he's way more successful probably than I will ever be when it comes to the sheer number of clients that you're going to have to deal with. But he deserves it because he works hard. He puts out a ton of good information, and he's got some good people around him. So good to hear that. I definitely do not begrudge anybody working with him. And yeah. So let's see. Top Gun. They build the interest into the cost of new cars. If you pay cash, you get a discount. If you use IBC, you get both. Not necessarily. So when I sold cars, I sold new cars. The dealership gets a certain amount. They have their costs, which they don't share with the employers or the employees. They don't share that with the salespeople. The desk people know what it is. But there's a lot of movement that you can get off of MSRP. It depends on the vehicle. And when I was selling them, it didn't matter how they were financing. Oftentimes we would do the negotiations first, and then they go in and do financing or whatever they do. It didn't matter. It was up to the finance manager to try and make the money that way. And that's the finance manager's job, not the salesperson's manager's job to figure those things out. But I would see really, really low sales prices. The biggest factor was the time of the month that it was and how pressed they were to hit the numbers. Because with a dealership, if you could be one car off of making like $100,000 bonus from the manufacturer, they're going to take a loss on that car to get it. If they're 2 or 3 cars away from it, they're going to take losses on those cars to get it. If they're not, if they've already made it, they won't even care. They will not discount that car past what they normally would. They are out to make money. So that the best, if for you the biggest thing is to get the absolute best price that you want to get, you want to try and wait for that. Me, when I go out and I shop cars, I don't really care that much about, and I know I should, because $500 seems like way more when I'm buying a computer as opposed to when I'm buying a car. It's still $500, but having been a salesperson, I don't give them that hard of a time. I usually just shop for the best deals, the advertised sales that are out there, so I don't have to negotiate. I don't mind negotiating. I'm actually pretty good at it, but I find it to be so much easier, and I actually don't mind paying a little bit of profit to the dealership because I know what they go through. And it's just, everything goes so much smoother. And if you have problems and you want to go back, like, you making a friend, if you make it easy on them, it's really easy to go back and get them to do other things for you. So you're kind of paying for a better relationship. People that come in there and they play hardball and they want to get every single penny and dime, the desk managers do not like those people. They will often not work with them just because of that. Or if a problem comes up, they'll be like, I don't care. Deal with it. It doesn't matter. Like, you created a bad relationship there. So things to consider. Let's see. The discount and interest flows to you. We got that one there. Oliver, it's a buy. You got the car originally for $31K. Okay. You're used to the SUV, so you'd like to continue with another one, and you wanted to see your options and move before you do your first car purchase on your own. Okay, so you got it for 31. It's 4 years old, about 4 years old, and somebody's telling you 19,000. What does Kelly Blue Book say on that? Because it seems like you might be able to get a little more than that. What do those go for new? What are you seeing those go for brand new? I'm interested. in knowing that. Alright, what happened? For some reason, I can't scroll on my chat now. There we go. Okay. No days off. Nope. Well, my days off are coming this weekend. I'm taking 4 days, so we'll be back Tuesday. Well, we're going to be back Monday, but Tuesday I'll be available to hop on and do live stream again. We'll do our normal Wednesday live stream, and I'll try and get on and do stocks in the morning. Credit score's around 800. Hey, good for you. That's awesome. That is a tough score to break into. Hopefully things will play out when it's time to go to the dealership. Good luck out there, man. It's good to have a high credit score. At least you don't have to worry about that. Oftentimes when you go in there, the dealer doesn't know how good your credit is. They'll want to try and run your credit. Don't run your credit at the first dealership you go to unless you're going to be buying. You can tell them what your credit score is. Tell them to assume that you qualify. Just tell them to assume you qualify for the best rate. Okay? You don't want people running your credit willy-nilly. Those places will run your credit and send it out to a bunch. Now, it's okay if the dealership you're buying from sends your credit out to a bunch of different places. However, if you're going to be leasing, they will probably just send it out to to Audi. I imagine Audi has a pretty good lease program. They'll probably give you the highest dollar amount guarantee for when you return the car, which will in turn lead to the lowest payments that you'll get. That's not always the case. Sometimes there's outside companies that they can go through leasing. So that's something that you can explore as well, but you typically get the best guaranteed value from the manufacturer, which means you'd get the lowest payments. And when it comes to leasing, it's a little bit harder to negotiate. One thing that you can do is shop around to the dealerships online. When I did it, it was kind of a fairly new thing, but they had dedicated people that would answer online inquiries, and they knew, and they would treat people differently because of this. But they knew that it's a couple of buttons for you to click and pull up another dealership. So they know that they've got to go to the best price that they can because you're doing your shopping online. They don't have the opportunity to get you in the car, get you emotionally attached to it when you do your test drive. They don't get any of the normal opportunities that they get as car salespeople that get people excited and not really paying attention to the things they need to pay attention to reduce their costs as much as possible. They try and get you focused on payment. Is the payment okay? Don't worry about the price. Does the payment match? If people focus on the payment, they can do whatever they want to with the actual cost. And oftentimes when they're telling you payment amounts, it does not reflect the credit amount that you'll qualify for, the interest rate that you'll qualify for, and the amount that you're paying. That gives them room when you get into the finance office for them to say, hey, I can add in all these extra things. You want some extra paint protection? We can add these in. It'll raise your payment, $1 or $2. And the reason that they can do that is because they've already got you hooked on a payment amount that comes with a higher overall cost. So they can add those other things in and it doesn't adjust your payment very much. So tricks of the trade, things to know. I know that may be a lot as a first-time car buyer. You're not going to remember all that stuff, but if you shop around online first, it will help. Is it possible to include gap insurance or just go through your own car insurance? Go through your own car insurance. Every insurance agency out there offers gap insurance. Gap insurance doesn't cost very much. It can be a good idea to have, although if you buy it at a really good amount, you may not need the gap insurance. It's most beneficial for people who trade in and owe a bunch of money on a car and they find themselves underwater. They owe way more than the car is worth when they drive it off the lot. That's what gap insurance is typically designed for. Not everybody needs gap insurance, so you may not need it. Definitely look into it. And your insurance company might be able to give you some advice on that too. So they'll be able to give you a quote on the gap insurance, and you can ask them, hey, if this gets in a wreck, how much is it worth? How much are you going to pay off on it? Because they should have some of those values. They might have experience with your car in particular. They might be able to look that up, or they may not. Get Gap on a Tesla. You know, Teslas have like a really high resale value. I don't know that you'll need Gap on a Tesla. I'm not planning to get Gap on my Tesla, anyways. But it's been, I mean, as far as risks go, I haven't been in an accident in a long time, over 20 years. So, good. You're welcome. You're welcome for the advice. All right. Well, if anybody has any more questions, put them out now. Otherwise, I will do one more drawing because you guys have been here for a long time listening to me babble. And I just want to provide a last little bit of value to one of you. We're going to do a drawing. Pick a number between 1 and 10. I don't even know how many people are on the chat right now. But pick a number between 1 and 10. And we will get that random number generator up. I'll give you guys a few minutes. Give you guys a few minutes to, well, not a few minutes. I'll give you 1 minute to get your numbers out there. In the meantime, if you've got questions, type them up. Okay, your cousin wrecked his 3-month-old Model X. He paid 102 new. AAA paid out 75. Oh, wow. And they said that's what they sell for. No way. Worst part is he works for AAA. Okay, yeah. In that situation, get the Gap insurance. Like I said, check and find out what your insurance company says they're worth, because it can definitely be worth it in that situation. I'm surprised that a 3-month-old would be selling for that. If you look at Kelley Blue Book right now on some of the Teslas out there, they're putting used ones as selling as same as new ones, basically. Depends on the... oh, that's all right. Not monopolizing the chat. All the questions, I think, were good. All right, a few more seconds. Nah, you guys weren't monopolizing it. We don't get as many people on these live streams as we do on the stock ones. So this one usually sits around like 11 to 15, maybe 20, whereas we get up to like 150, 200. I've seen 250 actually, I think we hit at one point on our stock ones. So those ones are a blast. I have a lot of fun seeing those numbers just go off the chart. But these ones, this is where I feel like I provide way more value to you guys. So it may be smaller in participation, but hopefully you guys get a lot more value out of it. I think it feels like I'm giving a lot more value. He said it's the worst to drive off. Couldn't believe it. I bet. That is pretty much a shock. What model do you drive? Are you asking me? I don't have a Tesla yet. I've got a Cybertruck reserved for when that comes out, the 3-motor model. I currently drive a Hyundai Ioniq hybrid. And I bought that in 2018. Got that new at the dealership. That was a really nice car. I've never had one that got that good a gas mileage. I've gotten up to 65 miles a gallon on that car. And that was on a long trip. Like I drove all the way down to San Francisco from up here. Not quite San Francisco, but close to there. 65 miles a gallon. That was amazing. So, scared me so when you get your Y next month, you're buying Gap. Yeah, definitely look into that. But like I said, check with your insurance company and find out what those are valuated at. Here's the thing. Some insurance companies pay less than others. I bought a brand new 2000, I think it was 2011 Nissan. I don't remember the model, but it was one of their entry level, nice looking ones. Not the Altima. It was a little more sporty looking than that. But I bought that brand new. And I bought it for I got a big, huge rebate. I think I got it for like $12,500. MSRP on that was 16 and change, almost 17,000. It had a great stereo system in it. That car was awesome. I let one of my employees drive it for something, and another car pulled out in front of him, and he wrecked it. And this was like 2 years later. Yeah, I think it was about 2 years later. So I got to use it for 2 years from brand new. I had Progressive insurance at the time. I think it was Progressive. It wasn't my fault. It wasn't my employee's fault. So I expected the other company to pay for it. The other guy's insurance to pay for it. The other guy had State Farm. Progressive looked at it and said, "Hey, if you want, we'll just give you a check for the car. It's totaled. We'll give you the check and we'll negotiate with State Farm." They wanted to give me $8,000 for that car. Well, I looked it up online and I was like, damn, if I want to replace this car, people are selling this car just like mine for $12,000, $13,000 even. About the same amount of miles that I had too. So I was like, no, that won't work. I'm going to just negotiate with State Farm. They gave me a rental, or I didn't get a rental. So when State Farm called me, I said, okay, they made me an offer of $11,000 right out of the gate, $11,000. I was like, hey, I didn't get rental insurance from you. You're not paying for a car. This is what it costs for me to replace it. It's going to cost me $13,000 to replace it. And here's the proof. I sent them the links to the private sellers that had it listed at this. And they came back, offered me $12,800. So I basically drove that car for free for 2 years. I didn't even negotiate anymore. I'm like, okay, deal. I'll take it. No, it wasn't a Maxima. Sentra. It was a Nissan Sentra. And it was a little sporty looking one. It was a really nice car. Loved that car. Had a killer stereo system in it. That was stock. It came stock with it. I had a lot of fun with that car. Okay, I'm going to go back. Let's go back to the numbers. Everybody's got plenty of time to get their numbers in as I'm rambling on. So let's do our random number generator. Let me switch screens so you guys can see it. Is this the right one? There it is, random number generator. Okay. And here we go, pushing now. Number 4. I don't know if I saw number 4. Anybody pick number 4? There's no number 4. All right, I'm going to hit the number again. We're going to do another one. Here we go. Pushing now. 8. Robert, winner. Robert is our winner. There's only one number 8. So there you go. You remember how to claim your prize. You got to send me an email. The link in the comments to this should have a link to the Teespring store. You can pick any item you want. Yeah, I figured people would put in a 4 right after that. There's about a 20-second delay, so you're too late. There should be a link to the Teespring store in the description for this video, and there should be a link to the 2 books. Take your pick. Anything out of the Teespring store or one of the books. You buy it. Send me the receipt. I will reimburse you for the cost of the product and the shipping. Just don't order the 1-day shipping. Don't make it really expensive. But other than that, take your pick. Anything on my Teespring store or those books. All right, what's the most expensive car that I've bought? The most expensive car was probably my Sienna van. I think we got that for $26,000, $25,000, something like that. We got it brand new back in 2008. My next was my truck. I have a Toyota Tundra. I bought it brand new, but I got a killer deal on that one. Original price was higher than the van, but I got like a $5,000 or $6,000 rebate. I ended up picking that up for like $22,000, and that was an unbelievable buy. My wife was surprised when she saw me come home with that because she didn't even know we were truck shopping. But I couldn't pass it up, so I bought it. And I still have that truck today. Bought it brand new back in 2008. Still driving it today until I get my Cybertruck. Okay, you have a 2012 Prius V, 6 miles per gallon. My mom has a 2016 Prius C, and I get better gas mileage than she did. She gets right around 50 miles a gallon, between 40. She's got kind of a lead foot, so maybe closer to 45, but 45 to 50. S&P 500 rebalance happens every quarter, correct? Yep. So if Tesla doesn't happen to get into it coming up, then they could again in 3 more months, right? Yeah. Yeah. I mean, they can do it before. I don't think they have to wait until the rebalance to do it. I don't think they have to wait till the rebalance to do it. But I could be wrong. I haven't done a lot of research into that. But they can absolutely do it again if they don't do it before this one. All right. So, any predictions on the market tomorrow pertaining to Tesla? No. I need to see what news has popped as of today. I need to see what comes out in the morning. I mean, that really makes a big difference what comes out. If there's anything that gives a reason that there should be a bunch of people going, oh, wow, really? Let me look at that stock. I want to own that stock. We might see it jump up. I haven't seen that yet. We're still waiting for that S&P 500 inclusion. So I think until we see that, we might be trading fairly even, maybe even with some drops as other people rebalance their portfolio, like a couple of major players did. And, of course, Tesla ends up selling off the new stock that they have. So something to keep an eye on, though, is when the S&P 500 does get close, you may see the indexes buy it prior to the announcement. I would assume that the S&P 500 may give a heads up to some of those indexes so that they can pick it up and spread it out over a few days so that they don't all get stuck trying to buy after the announcement, jacking the price way up. That's just my thought, though. I don't have any insider knowledge on that. I am not a professional stock market person. I'm not a professional day trader, not a professional anything when it comes to the stock market. Stumbling along with this like much of you do and feeling our way along. But I do like to do research. I do like to pay attention to all this stuff and connect the dots. So with everything that we put together in our hive mind, I think we can make some pretty good decisions. Hold on for dear life, Toyota truck. That's right. That's right. How excited are you for your Cybertruck to come in? I'm really excited. I am very excited. So I pull a trailer with my Tundra, and it really hurts my gas mileage. I only get, like when I'm pulling, I have about a 10,000 pound trailer. And when I pull it, my truck can handle it. Not really much of a problem there unless I'm going up a steep grade. No issues pulling it, even when I'm totally loaded down. But I get like 8 to 10 miles a gallon, which really sucks. And so my range on that is like 230, 250 miles maybe on a tank of gas. The Cybertruck, I'm going for the 3-motor one. That one's got a 500-mile range, and it will pull up a grade no problem. So I'm really excited what that offers, as well as all the accessories. Yeah, really excited. And when that gets closer, I will definitely do some videos on that. But I'm trying not to turn my channel into a Tesla channel. Yeah, the C is smaller than the V. Yep. Oh, yeah, I bet hypermiling 54 miles a gallon. It could probably do something similar to that with the C. I always find that hard to do. I tend to... It's not worth it. When I'm driving my truck, it would make a big difference. If I get an extra 10 miles per gallon in my truck, that doubles my range. It almost doubles, or maybe even a third. If I don't have a load on it, I can get 20 miles a gallon, maybe 18 miles a gallon out of my truck. So you add 10 miles a gallon on that, huge difference. Because a tank of gas in my truck cost me $60. Tank of gas in the Prius C is like $8. So getting an extra 10 miles a gallon on that, don't even really care. It's like an extra gallon of gas. So the reward isn't there. So I don't really worry too much about trying to do the hypermiling. But that's cool though. I mean, it certainly doesn't hurt. Tesla not getting in wouldn't hurt the stock price too much, you think? I don't think it would hurt it because everybody's expecting it to come in at some point. Some of it is priced in. Some of the expectation of getting into the S&P 500 is priced in, but they're only going to be able to ignore it for so long. You've got one of the highest valued companies in the country. How do you ignore that? If you're the S&P 500, you can't ignore that. My car, 2005 Magnum RT. Okay, that one's a gas eater. Definitely less miles per gallon there. How much is the Cybertruck version I'm getting? I upgraded for the full self-driving. Base price on the 3-motor one is 70,000, so my total is going to be 77,000. Nope, not 85,000. You just lost that bet. And that price is easily competitive with all the other major trucks out there that are gas guzzlers, have major engines in them, and can haul that much weight. So like it's basically the equivalent of a 1.5 ton. I think the payload capacity is over 3,000 pounds on the Cybertruck, which is that's huge. Yeah, 13 miles per gallon in the Magnum. You hypermiled to Southern California all the way up to 20. Wow, that's pretty good. That's pretty good. How did it feel though to be driving that car and watching everybody passing you going up the hills? I've when I try hypermiling it and I got the family in the car, oh man, they're hating it. They're hating it. It adds so much time to the trip, and they just feel like they're going so slow. I'm like, so? Trying to save gas. Christopher, I have other stocks you invest, and that we can discuss next time. Thought you just wanted to commentary on Tesla. Yeah, I mean, that's really the only stock I pay attention to. You're welcome to talk about any other ones, but I probably won't be able to help. Those are good questions for the other live stream when we have people on that stream that invest in all those stocks. So even though, because I'm not a professional trader, I'm not up on all the companies. I'm basically focused on Tesla right now because that's where my efforts are. There is another company that I like to use that I've been using before. It has a really good dividend. I talked about that in my other streams. Orchid Island Capital. Orchid Island Capital. ORC is the letters. Great dividend stock. How I used it worked really good for me. But other than that, I don't really pay a whole lot of attention to a lot of other companies because I'm focused on. I'm really busy actually doing insurance, designing illustrations, and now I basically added in these live streams about trading, which has sucked up a lot of my days. But yeah, just know I'm not a professional day trader. I'm not pretending to be. You're gonna get value from other people in the chat though that can help out. Andy has a lot of good info on a lot of other companies. Andy says, "Okay, gotta go." Oh, significant other's getting pissed or typing in bed. All right, man. Good night. We'll see you tomorrow. Am I leasing or buying? I'm buying. I haven't done any leases since I had my Tundra right before this one. I leased that one. But other than that, then I leased a Tacoma as my first truck. And I leased my other Tundra too, my first Tundra that I started my pressure washing business with. I leased that truck for 5 years, and then I bought the truck after that because I'd already beat it up, and there's no way I'm turning that one back in after using it as a work truck. So that was what I did with that. So I have experience with doing some leases, but I generally don't like them because I tend to drive a lot more than what leases allow. I don't like being stuck to that. 70 miles per gallon, not too bad. Oh, 70 miles per hour. Hey, that's actually really good. 70 miles per hour, getting 20. That's all right. Can't complain with that. I'll tell you, I went down to California in my car, the Hyundai Ioniq Hybrid, and I think I drove 80 miles per hour, and I got 60 miles per gallon. So that was pretty nice. As per S&P 500 for Tesla or any company to qualify, they must meet the following. Just thought you'd like to know. I would share. I have not looked that up. Headquarters in the U.S. I know they got to have 4 profitable quarters or a year of profitability. And I don't know what the wording is. I think it's 4 quarters. The value of its market capitalization trade annually. At least $250,000 of its shares trade in each of the previous 6 months. Oh, interesting. Okay. Well, Tesla definitely qualifies there. most of its shares in the public's hands at least a year since its IPO. Some of the previous 4 quarters of earnings must be positive, as well as the most recent quarter. Yep. Oliver, do you think it's possible to try and match a lease and purchase price? You might as well buy if you can get it near. Sometimes it is. Not necessarily. I mean, yeah, as far as purchase price, absolutely you can match it. You could probably get a better price purchasing it than leasing it. What it comes down to is your payments. Well, not necessarily your payments, but sometimes the payments are fairly close. It depends on what the guaranteed resale value is at the end of your lease. If it's a bad resale value, oftentimes a really good interest rate on a purchase will offset, and you'll get a close monthly payment buying it as opposed to just leasing it for a few years. And when you lease it for a few years, you got to put a few $1,000s down. You can often buy it without putting any money down. So some things to consider. There's no reason that you can't get a quote for both, though, from any dealer that you're talking to. Market cap of $8.2 billion as of February 2019 guidance. Okay. The second to the last one worries you. This one. The sum of the previous 4 quarters must be positive, as well as the most recent quarters. That one's no problem. He's gotten the last 4 quarters. And that's going through the pandemic. I expect the next one will make it also. So consider this. If we have to wait until earnings, Q3 earnings, it's almost guaranteed that it can be positive because of that $5 billion sell-off that they just did. Because what they can do with that, if he needs to, he can pay down the debts. If he pays down that debt, from what I was seeing on a couple of analysts, was the gap income, which a lot of people are complaining about because that wasn't positive. They were saying the only reason Tesla was positive was because of the government subsidies, basically. But if he had took that $8 billion in cash that they're sitting on and paid off their debts, now the gap income is positive. Well, they could do that with the $5 billion that they're going to be raising. So, nope. I mean, everybody expects that it only takes the 4 quarters. That's all you need to reach it. That is all you need to reach it. But we're going to be at the end of another quarter here at the end of September. So if they want that one, we don't have to wait much longer. That's what I'm looking at. So yeah, I'm not too concerned. I definitely think we're going to be seeing an S&P inclusion. And I mean, that's the overall consensus too, is that it's just a matter of time. When do they want to pull the trigger? And in my mind, because Tesla was not a part of the S&P 400, all of those shares are going to have to be bought at once to get into the S&P 500. I think that figuring out those details is where the challenge is and why it's probably more challenging than usual. So with that, we've been going, way longer, 3 hours. Loved the questions. You guys asked a ton of good questions. Thank you, Poker, for your 2 voicemails. Please, if you guys are interested in leaving a voicemail message, so far Poker has been diligently upholding that end and providing us with some awesome questions that we can play. I love playing those. I think it's also good that other people get to hear somebody's voice besides mine, as long as I can get the software working out. So please leave me a voicemail message. Ask me some questions. I would love to play it on here. I'm hoping that I can take some of the pieces of these live streams and cut them up into videos. And so I would rather have somebody else's voice that I can put into those videos when I do put those out. Just provides a nice little change of pace. All right, see you tomorrow. I'll probably be on at 6. 6:30 is when the market opens on my Robinhood account, and I want to kind of already be prepared when it opens. So I try not to start the live stream then, because I may have to actually be hitting the buttons, buying or selling, like I should have done today when it started. If I had, I would have been in a really good position at the end of the day, regardless of how it went up and down. So you should take live audio questions during the streams. I'm working towards that. I want to do that. Somebody told me how to do that on one of my other streams, and I've got to use Discord. But getting that coordinated, since I'm just a one-man show here, it takes some time, and I'm really busy helping insurance clients. So it kind of takes a back seat. I got to make it take a back seat. Well, things will slow down. I'll figure it out, but I've got to figure out the details on it. If we get through this pandemic, maybe I can actually hire some help. But it seems like something that might be difficult to do remotely. So, you have Discord. Yeah, I've got Discord. Oh, it's easy. Okay. All right, we can try and connect if you want. If you want to try and help me out with that. I got a lot of things on the plate though, so finding some time is tough. But if you would go to my Calendly and pick a time on there, just reserve one of those 20-minute sessions, and we can figure it out during that. That'd be awesome. All right, so easy. Everything's pretty easy once you actually do it and you kind of get used to it. I'm not used to Discord. I only kind of use it a little bit for one of the other people that I follow. So you can set up a test server channel for you. Awesome. Well, I'm open to any help, so I would appreciate that. So yeah, if you can contact me, because that way you can set up a time that works for you. And on my Calendly, it has my schedule. So if there's an open slot that works for you, just take it, and that would be awesome. Welcome the help. All right, we'll see you tomorrow. See everyone tomorrow. Thanks for joining us. Love the questions. Love the interaction. And we will be back next week.